part of today, or the first thing this morning, is going to be one of our premier partners. Our carrier relationships are always strong, and we try to always seek out only the best when it comes to products. And so insurance, just so you all know, is a very complicated, not products, just the way that businesses are structured today. You're going to learn a lot about insurance as you get through this. You're going to say, well, who are these guys, and how do they relate with these guys, and why are they there for this and that and the other? Let me just tell you guys something. Anytime you meet somebody who we introduce you to, it's because they're a partner of ours in some way, shape, or form. They are somebody who we look to for resources, somebody who provides resources, and somebody who provides support and training at a high level. And that's all we seek out. We're looking for the best of the best when it comes to carriers, when it comes to partnerships. And the Alliance Group has been a big partner of ours in growing our business as far as National Life Group is concerned. Today, we're going to be talking about National Life Group, or this morning we'll be talking about National Life Group and the benefits that it offers to your customers. We have Stephen, right? How do you say Steve? All right. Walther here. And you're from where?
I live in Eagle, Idaho.
Idaho. He's bringing potatoes. No. No, by the way, they had some huge, massive potatoes yesterday for lunch. So I'm going to bring up Steve, and Steve's going to give you guys a rundown of the products, the services, and who the target audience for National Life Group is in. So we can give Steve a round of applause.
Yeah.
And
all right,
you got it, man.
Thank you, everybody. Thanks for having me. You guys, just so you know, I travel around talking to a lot of different groups all over the country, and I can say you're with a good one. These guys do everything that they can to help you with new markets, with education, with training, and doing a lot of stuff that a lot of other marketing groups are not doing. So know that you're in good hands and on cutting edge with a lot of stuff. So that's really important. For those of you watching via the internet here, I just want you to know the camera, they say adds 10, 15 pounds. In my case, it adds 20 or 30. So I'm really a lot skinnier than it looks right now. So keep that in mind when you're watching this. As David said, I live in Eagle, Idaho, and I'm not your normal company guy. From the standpoint of, I actually don't work for the insurance company. I technically am not an employee of the Alliance Group, who I'm representing today. I'm a rep and an agent, just like many of you guys. And what makes that different is some of the stuff we're going to talk about today, I actually use sitting across the table from clients all the time. I have my own practice. I'm Series 7, 2466 licensed. I work on the securities. On the investment side, when I'm gone, I have some folks in my office that take care of stuff. But the Alliance Group hired me to go out in the field and train agents, and I train a lot of CPAs and estate planning attorneys and that type of stuff about our products, what they do, and how you can implement these products into your business. So before we dive into my PowerPoint, I wanted to jump back a little bit to something that David said earlier, that he said social media. Post stuff on social media, talk about stuff on social media. Let's take a step back. First off, how many people use social media for their own personal stuff? How many use it for business? Okay. If you're not doing it, you should look at it. If you don't know how to do it, find a 12-year-old kid or a 9-year-old kid to help you get it set up, because it's that important. And it's funny, my mom is on Facebook. I have to change what I post now because my mom's watching all the time. But my mom is on Facebook. My dad, my 78-year-old dad is on Facebook. Now he has to call my daughter all the time and get her password because he can never remember how to log on. But everybody's on Facebook. Now, what do people paste on Facebook besides what they had for lunch?
Everything.
They do, but they post when they had a kid, when they have a new grandchild, when they bought a house, when they got a divorce, when they got married. All of those things that are important to us, they are. Not only are they important for the tax side, but they're important to the life insurance side, to life changes, things that happen in life. So watch what people post. Now, I wouldn't say directed at somebody when they get a divorce, but maybe post something on your site that may be pertinent to that. Or send them a private message that said, hey, I saw this just happen. I saw you just bought a house. This reminded me of you. Take a look at this video. This is something that I think would be of interest to you. And I'll tell you, you'll make so many more sales. And not only that, when you start putting that on there, let's say you put something about mortgage protection on your Facebook page. People now, if you have a brochure on mortgage protection, nobody reads it anymore. I say that as they're handing out my brochures. No one reads that anymore. They click on a video and they watch a video, right? And we all, I don't know if you've gone on YouTube or even now Facebook has that new thing, you click on it and you go down that video rabbit hole. Next thing you know, 3 hours later, you come out of it. But people watch a video and they watch it from beginning to end, especially if it's short. We've created a whole library of videos you can use on a whole bunch of topics. And those videos are educational. We have a whole set of testimonials. And the testimonials are, this is what happened to us, and this is how life insurance with living benefit riders helped us in that situation. So these are ready-made tools that you guys have access to right now. I know I'm getting the cart a little bit before the horse with regards to talking about living benefit riders, but I'm going to show you a couple of the examples. And I'm going to kick off with one of the videos on living benefit riders and how they work. Now, this is the video right now from the website that I'm going to show you. You can use. You can cut and paste it. You can email it right from there. You can copy the link, put it on your Facebook page. You can send it in an email. You can use it however you want. Because you work with David and Raul's team back here, you have access to all of the material I'm going to show you today. So because you're with this group, you have access to it. So this is just another extension of their marketing team that you have access to. So let me show you this first video, then you'll know kind of a little bit what I'm talking about. I think. Here we go. Whoops. How do I get back to screen sharing? I didn't mean this. Whoops. Am I screen sharing again?
Yes, it is.
Okay, so this, okay, good. This website right here, just so remember when he said, I'll tell you when to write stuff down. Write down this website. It's called TOPS Alliance, TOPS.com, TOPSalliance.com. And the password, the secret password is living benefits, one word, living benefits. Perfect, thank you. And on this website, there's all kinds of information you can use. But if you go to resources and you go to videos, there's a whole bunch of different videos there. There's client testimonials, educational, marketing, Spanish, Portuguese. A third of our business comes from non-native English speakers. So knowing where we are right here in South Texas, we have almost every video we have is in Spanish, spoken by a Spanish speaker, not just translated, dubbed over. Some of the cartoon ones are dubbed over, but they're really, really good information. A lot of our marketing materials, a lot of our books, some of the materials we hand out, we have some in English and some in Spanish. So know that as well. If your clients are predominantly Spanish speaking, send them a Spanish speaking video. If not, send them an English speaking one. Some of the places, it says Portuguese on here because we work with a lot of Brazilians in Florida. So if you have any Brazilians, we have that. We have some marketing material. We're working on some Korean, Vietnamese, and some different stuff as well. So depending on the market that you're in, let us know. We might have some information for it. So I'm going to go to educational, and then I'm going to go, the first video I want to show is just the introduction to living benefit riders. And so this is a great one. It talks about living benefit riders and why it's so important. So
when Alexander Graham Bell invented the telephone in 1876, he designed it to do one thing: make phone calls. Hello. These days, it seems we use our phones for everything but phone calls. Today's phones are our text messengers, calculators, books, planners, navigators, our cameras, music players, internet browsers, stock traders, even our flashlights. Phones evolved to include so many other useful features because we needed them to, yet we still just call them phones. This same evolution by necessity has happened with other products over the years, and life insurance is no exception. When life insurance was invented way back in the 1600s, it was also designed to do one thing: to financially protect your loved ones when your life is over. And like phones, life insurance evolved because we needed it to. With modern advancements in medicine, suffering a critical illness like a heart attack, stroke, or cancer diagnosis no longer necessarily means death. In fact, 90% of people who suffer a heart attack these days survive that event. That's where the new, evolved kind of life insurance policy comes in, one that adds living benefits. Living benefits policies are essentially the smartphones of life insurance. They allow your life insurance policy to not just be a parting gift, but also provide the ability to accelerate the death benefit if you suffer a critical, chronic, or terminal illness. This ability can help save your financial life by unlocking a whole new list of ways to use your policy while you're still living. And oftentimes, it does all of this at the same price as the old kind of life insurance. Living benefits protect you, your loved ones, and your wallet, not only in case you die, but also in case you don't. Two things always happen when you suffer a critical or chronic illness. Your expenses go up and your income goes down. When your expenses get higher than your income, that's when debt begins to pile up. This is the exact trap that so many Americans are falling into every single day. In fact, 60% of all bankruptcies that occur in the U.S. are the direct result of a critical illness and the medical expenses that follow. With living benefits, the policyholder has the option to accelerate a portion of their death benefit to replace their income and help with those added expenses. These benefits are the difference between just surviving the illness and having a life afterwards. And the best part is, they come at no extra cost to the consumer. So what kind of life insurance is protecting your family? Your granddad's traditional death benefit only coverage? Or the new Evolve life insurance with built-in living benefits? If you're still using the rotary phone of life insurance, maybe it's time for an upgrade.
Pretty cool, right?
Contact the person that shared this video with you to find out how you can add living benefits to your coverage.
When you're meeting with your clients and you're going through the fact finding and you're asking questions, they say, oh, we already have life insurance. You say, oh, do you have the old kind or do you have the new kind? What do you mean? Well, let me show you. Because a lot of people that do have insurance, they probably don't have the living benefit writers. Living benefit writers are relatively new. National Life Group, Life of the Southwest, actually invented them 20 years ago. They're the first company to have them now. A lot of companies have copied them. So innovators have been paying the claims the longest. They know how to price it. They've been doing it. So rest assured that when we're talking about living benefit writers, this is something that we've been doing for a while, but not a lot of the other companies are new to the game to it, and rest assured that we know what we're doing. So again, I talked about brochures, and so I gave everybody a book, and you're like, great, he gave me a book about insurance. But this is not just any book. This is like one of the coolest things. Talk about differentiating yourself and going to your clients, and this works best with millennials because you get the wow factor. So I need an assistant. Somebody here, come on up. So on the back of this book, there's an app. You have to download this app. Okay, download the app, and then I need you to hold the book up like this. You download the app on your phone. There you go, Vanna. There you go. And when you hold that over it, turn it up. When you hold it over it, the book comes alive. You guys see that? So in the book, there's a whole bunch of, it talks about living benefit writers, how they work, and why you need them. In the book, there are videos. In any place that there is a play button, you hold the app over it, and it'll launch the video right from the book.
Wow.
Yeah.
Wow.
Isn't that cool? So it's really cool. Thank you so much, Vanna. For your help today, I'll give you a second. And if you guys, if you submit 5 apps, and I'll send you guys a book too. I'll send you another book. So let them know, and I'll send you more when you guys get going. Now, how do you use this book? Share it with a client. Hey, go home and look at this. Put your stamp on the front page of it. Has your name and address and everything on it. Say, when we come back on Tuesday on our appointment to meet, bring it back. I want to talk about it. And show the client how to download it, how to do it. You'll be amazed. You'll get your client to read a book about insurance because they'll go through it and want to watch all the videos. So it's a great way to get your client engaged. Now, if I'm sitting with a retired couple that they have a flip phone, don't even go down that road. But if somebody that's a little more tech savvy, they love it. They eat it up and they do it. So all those videos that are in that book are on the website as well.
Are the books in Spanish also?
They're coming out in Spanish. Great question. Right now they're not. The videos that are in the book you can get on the website in Spanish. The book it's in translation right now to it's a whole programming thing to go back and do it all. It's a little more than just reprinting it. So we're working on that right now, and hopefully by third quarter we'll have that book in Spanish as well. So stay tuned for that. So speaking of do we have it in Spanish, one of the things I want to point out to this room is the Alliance Group, our group that does the marketing and creates all this information. Our number one producer in 2018 was a non-native English speaker, Vietnamese. He lives in Houston. Our number two producer in 2017 was a CPA. Did 1.6 million of life insurance target with us. CPA. So he came about it from the tax side. So, and then 3 out of our top 5 MGAs in the country work primarily in the Spanish-speaking community. So we get it between the taxes and the other languages, the Spanish, the different stuff. There's a huge opportunity, and we're creating marketing and targeting those markets because we see that there's a tremendous amount of opportunity there. So so be aware of that when you're going through it. I handed out that CPA that I mentioned that was our number one producer. he changed up his fact finder when he sits down with clients. And I shared a copy of it with you guys. Feel free, I can give you this in a Word document that you guys can. You can ask David and Raul for in a Word document, and I can send it to you. So you can put your logo on it. You can change it up however you want. But the reason that I think it's good for tax, for tax folks is, are you asking all these questions? And sometimes people come to people that do their taxes, and they're asking the minimal stuff that's on the input. They're not asking the things that really can make a difference on helping and what the people really need. Changes in their life. Ask these questions. And my presentation today is really in large part about asking those questions. How do you dig into what your clients really may want and need? All right, let's dive in. So clicker. Perfect. So I think I talked a little bit about all that stuff right there. My market, and when they brought me in, we're not going to dive into a lot of that today, is the advanced markets. So in working with business owners, if you have any situations where you're working with premium financing, captives, ESOPs, defined benefit plans, executive bonus, retirement plans, that's where I can help. If you call and help me and ask for help on a case, I'm never going to split a case with you. I'm here as a resource for you guys to help you with it. If I don't know it, we have a team of CPAs and attorneys in our office that can help you with diving into what may be there. That's me. Now let's talk about, it's important to know the company that you're representing. You'll hear me today say National Life Group and LSW interchangeably. National Life Group is the mothership company. They've been around for a long, long time. Founded in 1848, they've been around 171 years. So it's not just some new company that decided to start selling insurance. They've been doing it for a while. They're in Montpelier, Vermont. How National Life Group and LSW came together was about 21 years ago. National Life Group was a captive company. What that means is that all of the agents were employees of the companies, of the company. They no independent agents, all captive. And they said, we want to get out and be nationwide, and we want to have products that are in every state, and we want to go to independent channel. How can we do that right away without having to reinvent ourselves? The best way was they bought another insurance company. They bought LSW, Life of the Southwest, which for y'all, you might know Life of the Southwest more than you know National Life Group because they're from Texas. LSW is headquartered in Dallas. So they haven't, we use National Life Group paper if it's in the state of New York. As those of you that know, New York has a whole different set of rules with regards to insurance. And we use LSW for every other state. So it's National Life Group, but it's on LSW paper. So it's a little confusing, and I think they're gonna, over the next few years, start working towards just all being under National Life Group. But for right now, those are the rules that we have. So when you're getting paperwork and you're running quotes, make sure to run LSW, not National Life Group. Okay, but so you'll hear me say it both ways today, but LSW is the one. So it's a real interesting story. This guy started the company in Montpelier, Vermont. Montpelier, Vermont is in the middle of nowhere. Literally, it's the capital, but you go there now and there's the capital. I think the town is like 3,000 or 4,000 people, 5,000 people. A couple thousand work at the home office. They bus them in from Burlington, about 45 minutes away. And the town is so small that there's only, there's a motel and a hotel. That's all that's there. And having all these agents come from all over, they didn't even have room for agents to stay. So they built an inn, and it's like those of you old enough, it's like the Bob Newhart show. This old New England inn, and you go in and when I first went there years ago, the rooms didn't even have locks on the doors, and no TVs in the rooms. They have a TV in the living room where there's a big fireplace, and so it's an insurance company that has their own. It's a totally different feel. The CEO, I heard him once say, "We don't want to be on Wall Street. We want to be on Main Street," and they really do. It's a completely different everything than any other insurance company. They want to target Middle America. All they do a lot of advanced stuff, big cases, but their target market is Middle America, and that's where they want to be. He said, I heard him once say too, "You'll never see our logo on a blimp. We want to get back to the community." So one of the things too, I'm not getting into this in the presentation, but if you guys have any charities, any like breast cancer walks or anything like that, you want support, let David and Raul know. We might be able to send you a booth or send you some material. We might be able to send you and help pay for your entry into the thing and help you get set up with all kinds of stuff for breast cancer awareness or all those different things that are in your area. We're really big on, rather than, again, advertising on a blimp, we want to give it back to the local communities. So again, a little bit different from that perspective. The other thing is good, highly rated. One of the big differences too is we're a mutual company. Does everyone know what that means? It means that we're owned by the policyholders. We're not owned by stockholders. Several other companies, a couple of them that got in trouble back in the crash, the last one, not the one a couple days ago, but the one a few years ago, they were stock companies. And what that big difference is when they have to appease stockholders. So when things aren't going right and they have to pay dividends and keep the stock price right, what do you think they do? They cut dividends to the clients or they raise insurance costs, right? Mutual companies are a little slower to move because they don't have to move because Wall Street dictates they have to. So it's a big difference from that perspective on who owns the company and how they treat policyholders, because they're treating themselves because they're owned by the policyholders. So that's a big distinction. We have term. Now, Universal Life right now, we've done Universal Life for years right now. I don't know if you guys are aware of this. I'm not going to dive too much into the weeds, but all insurance companies are required to go on new mortality rates as of January 1st, 2020. And everybody's repricing all their products. We priced all of ours except for our Universal, and our Universal is in, you have to get it approved with each state. So right now it's coming off the books for the new one that's coming out hopefully towards the end of the year. So right now, term, equity index, whole life, survivorship. And what makes that unique too is we have every one of the products we offer, National Life Group has the living benefit riders. In that video, those things, chronic illness, critical injury, critical illness, terminal illness, built into it automatically. The term, you can get it on term. Now, the term, it says it's the same cost. I want to be very clear on this. The cheapest terms in the free world, like the Banners, or whoever the cheapest term is, we're a little bit more expensive than that. And what we find is if Banner is $26 a month, we might be $28, $29. And what I do is if price is really a big thing to your client, and in that perspective, say, hey, here you have Banner. I'm just using them as an example because they're a lot of times the cheapest term. Here you have Banner. It's $20, $25, $26 as a death benefit. Here you have Life of Southwest National Life Group. It has a death benefit, critical illness, chronic illness. If you get cancer, you get sick, you can't get out of bed, all these things, you can access the death benefit when you need it most. This one's $28, this one's $26. Which one you want? I've never had a client take that. They always buy the other one. So you have to show both if you want to do it that way, or just show this one, because that's better for them in the long run. All right, so critical illness, critical injury, chronic, and terminal is on all products. And the term, if you buy term with living benefit riders, it's convertible to any product we offer. Some of the companies out there say, oh, you can convert it to a permanent policy, but you have to use this company on the shelf that stinks and it's really expensive and terrible. So any product we offer, you can convert to. And that's important. That's important. So it's really important is if things change towards the end of the term and they know they're going to still need coverage, but they can't qualify. It's really important to have those. The other interesting thing is National Life Group and LSW, there aren't a lot of agents. It's growing right now. I think my slide says we have 30,000 agents. I think it's a little bit more than that. But in comparison, the number one seller in IUL has several 100,000 licensed agents. So there's not as many people talking about it. Not everybody on the corner has it. So something unique you have to talk to about your clients. It's kind of a special market. They're real selective on who they bring on to market their products. That's 30,000. I think it's a little bit more than that now, but still not very many agents compared to some of the big boys. When I say the big boys, we are the fastest growing life insurance company. I think this is top 17. I think we're 15th now. Raul, were you here? Did you walk out? They just announced it. We're either 12th or 15th largest life insurance company in the U.S. They're one provider of index annuities in the employer space. First company with living benefit riders, longest standing issuer of index annuities. We weren't the first, but we're the one that's still standing from the first ones that are there. So again, a long history and something that is important to know that you're not just some guy that's selling insurance down by the river in a van. All right, so some of our niches. Living here in South Texas, we probably work with a lot of clients that maybe don't have all their legal status. Maybe they don't have a social security number, but they have an ITIN. Anybody work with clients with ITINs? Yep. Right? Okay, lots. I've never had a room that had that many hands go up. It's big, huge opportunity. ITINs are people that are here that don't have social security numbers, but they're paying taxes. They went through they got the paperwork. You guys might even prepare that for them, being on the tax side, get that ready for them. So typically they're hardworking, employed, members of the community. They just don't have all their status legally here. And historically, they haven't been able to do anything with financial products, right? We can write life insurance in our annuities. We can write ITINs with National Life Insurance LSW. There's a couple rules that we have to follow. Is they have to be here permanently, meaning that they can't be here seasonally working. They have to have some sort of tie to the community, like rent a house, have kids in school, to be a member of a church or a club or play sports or something. You know, and you want to write a cover letter with it when you submit it. I'm meeting with Hector and Gloria, and they've been here for 12 years and they work here. They do this. They have kids in school. Write the cover letter that paints the picture. Because a lot of times there isn't the same background information that the insurance company can go out and get because they haven't been able to do anything. Okay, so make sure.
How about if they get deported?
They still have the policy.
They sell the policy.
Yeah, they still have it. It's theirs. They can't take it away when they get deported.
Okay, so if they die in Mexico, still the
Yeah.
money comes.
Now, if they get sick with one of the triggering events, they have to come here to a doctor to they have to have it done here. If they go back to Mexico, the death benefits paid, it can be paid to their beneficiaries. Yeah. Yep. But if it's a living benefit rider payment, it has to be paid and it has to be in the U.S. Okay. So that's huge, right? Huge opportunity, because a lot of times the folks that have ITINs only, a lot of times they're not saving money because they don't have any retirement plan. Great opportunity for IUL with those folks. Hey, Mr. Klein, here's a way to put away $100 extra a month and save it for retirement too. And you can put more in later on if you want, because they probably don't have a 401k or an IRA, right? And they can't get one a lot of times too because of the rules. What's that? An IUL, Index Universal Life.
Yes.
So I'm going to talk a little bit about IUL. In this presentation, we're not going to dive into the mechanics of how that works. I'm going to right now give you the 10-cent tour of how it works. But what we're going to do in the following months, we're going to do some webinars. So look for an invite from the folks here on the mechanics of how an IUL works, how the living benefit writers actually work from soup to nuts, and how to process business, all that type of stuff. We're going to start doing a series of webinars. So stay tuned for those. But an IUL, an Index Universal Life, is just like a regular permanent universal life. But instead of crediting you the interest, the insurance company buys options on the S&P 500. So if the market goes up, you get credited up. If the market goes down, they don't exercise the options and you get credited zero. So if the stock market goes down, you get zero. So you don't lose money. If the stock market goes up, you go up. Now they buy options with a cap, which means if the market goes up 20%, you don't get 20%. Usually it's capped at 10, 11, 12% right now. And that changed a little bit depending on the price of the options. So if the market does 7, you get 7. If it does 8, you get 8. If it does 20, you get 11. Okay, because that's the cap. Insurance company doesn't keep the difference. That's when the option is exercised, and that's how much you get credited. So from the perspective of saving money for retirement, you're getting market-like returns without losses, and you're saving money inside your life policy. So it's a great vehicle for people that haven't had a way to save for retirement before. And it's one of the fastest moving segments of the tax savings vehicles because it's tax deferred. So you don't get to write it off like you do in an IRA, but it's tax deferred. Then you access it via loans and withdrawals, tax-free access. So I'm talking to CPAs and accountants and bookkeepers and insurance people. I'm not talking to clients. So don't say this to your client, but really thinking about it from a tax perspective, it's like a supercharged Roth with no limitations as to how much you can put in and who can qualify for it. Okay. With in addition to that, with the death benefit and the living benefit riders. And the living benefit riders, the benefit is based off of the death benefit, not your cash value. So if you have a death benefit of $100,000 and you get sick, the benefit they pay isn't based off of your cash value in the policy, it's based off that $100,000. So you're always leveraging a much bigger number. Okay? Make sense? And I don't want to get too much in the weeds of that because I can see a lot of glassy-eyed already where I went down that little bit. So ITIN, great, and not just, I'm amazed. We typically think of the ITIN as mostly Hispanic. You'd be surprised. There's a lot of other people immigrating here from all over the world that have those same issues that do it. Now, I handed out another thing right here that says easy underwriting. This should be very much of interest to you. This easy underwriting is for under age 60, up to $1 million of coverage on our term, IUL, and whole life. No paramed. And you can get the best rate class. No paramed. Now, they may come back and ask for one, but what they're going to do is they're going to get all your information and they're going to go out onto the internet and they're going to look at your medical record. They may order your medical records, they may not, but they're going to look at your prescription history. They're going to get your driving record. They're going to go out and find all kinds of public information. And they're going to say, well, everything that, and you have to fill out the whole app answer all the medical questions because the paramed person isn't going to go do it. And if they say, yep, everything's good, everything checks out, prefer. And Raul can tell you, it's anywhere from 2 days to 10 days to get a policy issued.
And that's a big deal, guys. When Steve says no permit, he means no
Blood in your
medical exam required, where you have to have a nurse visit the client and draw blood, check blood pressure, pin cuff, and all that good stuff that I'm sure they enjoy a lot.
Yeah.
All of your major competitors, Allstate, State Farm, New York Life, they all require that.
Yep. So up to $1 million up to age 60, 61 to 65 up to 250,000. Anything above that or beyond that, you have to do a full medical paramed. And we're hoping to extend that a little bit more. And we're hoping by the end of the year, the push is that the clients, when you're doing the e-application with them, if you can do it paper or e-app, e-app is much quicker. But if you're doing the e-app, meaning you're completing the application online, the first part of it is going to be the signature. So the client does the signature. So and then you fill in their social security number, their address, their name, and it goes into the computer, and then the computer starts doing the background check. And by the time you get to the end of the application, they can say approved, what rate class and everything. Not every time, but they're hoping to have the majority of them approved by the time you finish. So you can go through the whole thing with the client and say, oh, you're approved preferred, you're preferred standard, you're preferred smoker, whatever. And you think you'll make more sales if you can have the deal done by the time you leave, rather than having to wait. In the old days, it might take, they'll order medical records, wait for lab results, you'll do all this stuff, and it might take 4 to 3 months, 4 weeks to 3 months. It wasn't uncommon. And by then, they had buyer's remorse. They talked to their cousin who has a neighbor who's an insurance guy. And, all kinds of things can happen. So the faster we can get these through. I wrote a policy on my wife and IUL when this first started out. I wrote it on a Friday night, at the end of the day in the office. I submitted it. Tuesday at noon, she was approved, and they deducted the premium out of my checking account. So it was like that fast. So it goes pretty quick. And we've had some of them in the same day, next day, it goes through. Now, on the ITAN stuff, I want to caution you is make sure to write a very good cover letter, because a lot of those folks don't have a lot of the public record history. And they may come back and ask for a paramed for those folks. So if you're meeting with them, say, hey, we're going to start this on non-med, and we may be able to do a non-med, but they may come back and ask. So set it up that you may have to come back and do something, because they a lot of times don't have the same public data that folks that have been here their whole lives have. Okay?
Do you have like a template of that cover letter?
Yeah, I can send you one. Yeah, and I have a really quick, little short 10-slide. Maybe we can do this too. I have a webinar that I can, or a PowerPoint that I can send you that has it all outlined, all the details.
All right, good.
Yeah.
Good.
So maybe that'd be the first one we do is an ITIN webinar. Sure. Okay.
You have a question, sir? That's something we could use with churches.
The easy underwriting, yeah.
No, I meant.
ITIN.
My wife and I would go to a lot of Hispanic churches.
Oh, by all means.
So go to the pastor, say, now we can do this. We'd like to have your letter saying that these people are members of your congregation, yada, yada, yada.
Yeah. Oh, by all means. Here's so. If you're doing work with Spanish-speaking churches, I'll even take it a step further. I have some slides later on in this, so when I get to them later on, I'll fast forward. Let's say you have a relationship with the church, or you know somebody that's going to a church, and they're putting $25 a week in the basket, or $20 or $10, whatever that number is. If you say, what if I could show you how to turn those pennies into dollars? Rather than giving the church $25 a week, when you go to church, $50 a week, $100 a week, however much they give, what if I can turn that into $25,000 or $50,000 or $100,000 gift? You think that would be meaningful to your congregation, to your church?
Good.
So
Good.
rather than giving, now sometimes that church needs that $25 a week, you just keep the lights on. So maybe half of what you do. And for a lot of churches, $25,000, it will help them a lot. And they can give that back. They can use it to bring people in. They can do all kinds of stuff. They can do ministries abroad where they go and help different folks in different countries. They can do all kinds of things. It's limitless. So to answer your question is, yes, you can use it to say we can work with ITIN members of your church. And you can use some of the Spanish-speaking videos and different things we have. Or number two, you can use it as a way of, and the ministers love that too, because now you can show them how to give you even more money. But one of the cool things with National Life Group is we, if you, on our IUL, our Flex Life 2 product, if you leave 2% of your death benefit to your favorite qualifying charity, we'll match it. Up to 30,000. So the church would get 60,000 at the max, 1.5 million. So we'll match it. So again, if I have a $100,000 policy, I leave 2,000 in my church. We're going to match it. That's 4,000. 4,000 may not seem like a lot of money, but that's big. But what I found is when I'm talking to my clients about it, the light bulb goes on, and I say, I never even thought about that. What if I leave 25% to my church? Well, yeah, we'll match 2% of it, and so they'll get 27%. Or I'll take out another policy for the church. And it opens up all kinds of doors to help more people and to do a lot more than you ever would have thought of. Churches, it works great. People, you might have clients that are near and dear to the Humane Society, the Boy Scouts. We do a lot of stuff for Boy Scouts. Here's another one. If you're meeting with someone that says, hey, I have all this money and I have this amount of money here. I have this money in a CD or a savings account, and when I die, I want this to go to my church. I want this to go to the Boy Scouts or to the whatever. So let me show you a better way to take that money and leave it. I tell my clients this is one of the things I love to say. Never leave your family or charities money. Spend your money, leave them insurance. Take a fraction of it. If I'm going to leave them 100,000, why not spend 75 of it, take 25 of it, and buy a single pay 25,000 with a $100,000 death benefit, and I get to spend 75,000. Or leave them, or take that 100,000 and make it 400,000 or 300,000. If they're older, even if it's 200,000, it's better than leaving it in your CD or checking account, right? Plus, this is the big plus why these living benefit providers are so important. If I have $100,000 in a CD, and I have an example of this we're going to get to, so I'm moving the horse and cart like this. If I have $100,000 in a CD, and it's for my church, or rainy day money, and I get sick, I get cancer, I can start dripping down that $100,000, right? I have it there, that's what it's there for. If I put that $100,000 into a life policy, I might be able to buy 200, let's say I'm 70, I might be able to buy 240,000, 250,000 of life insurance. So the charity or my family's going to get 240, 250,000 versus 100. But if I get sick, I have access to 240, 250,000 for paying for my getting better, taking care of stuff, access to that versus the 100. So there's not a situation where it's not better.
Is your LTC ready?
Yep, chronic illness. It's called chronic illness because of the tax code with the with how that is the 901, what is it, 1019, whatever that tax code is on long-term care. It's a chronic illness. So same triggering events. You can't perform 2 of the 6 acts of daily living. You can access 24% of the death benefit for 4 years and 1 month. So 50 months to get it all out. 2% a month or 24% a year. Access the death benefit while you're alive. Now, it's a slight reduction. I want to be really clear. If it's 100,000, you're not going to get 100,000 back. There's a time value of money calculation on how much premium and interest they would have charged during that time. So if you have a $100,000 death benefit and you go into a nursing home, the benefit total value might be $95,000 as you're older. If I get cancer when I'm 30 and I have a $100,000 policy, and let's say I get pancreatic cancer, the offer might be $75,000, $80,000. If I get skin cancer, it might only be $10,000. It's minor. It's not, my life expectancy isn't short that much. So if I get skin cancer, turn in a claim, and they offer me $10,000, I say I probably won't take it. But if I get pancreatic cancer or I get something more serious, and they say, okay, we're going to give you $75,000, you might take it all. You might take half of it. If you take half of it, you leave half the death benefit, and your premium's reduced by the new death benefit. Make sense? And we could, when we do a webinar later on, we can dive into that more specifically. So again, our niche, the living benefit rider story. Oh, 4 nationals. So we're talking about the ITIN, which is, now this is a big, and you guys know this, you guys work in these trenches every day. Biggest misconception by those of us that aren't in that market a lot of times is that you're dealing with laborers only. I worked on a case in San Francisco. The guy's making $1 million a year and he has an ITIN. He owns a pallet. He owns a pallet making company. So it's not. There's a lot of folks that have ITINs that are making good money here. That have businesses. They have all kinds of businesses. So don't worry about that. But let's say you have somebody that actually is a foreign national altogether, that maybe owns property, owns a business in the U.S., but they live in another country. We can write those folks as well. Now they have to have a net worth, and they have to own property here, and they have to have a tie here. They have to take the app, and they have to be here when you do it. But I'm not going to get into all the rules on how that works, but we can write some of those folks as well. Depending on the country, the rating is different. Like right now, Venezuela is a little bit more difficult than some other countries for obvious reasons. Mexico, I think, is it's ABCD, how they categorize. I think Mexico, don't hold me to this, I think it's a B, so you might not be able to get the best rate class. But still, for a lot of folks, businessmen in Mexico that come up here, own businesses, own property, own houses in the United States, that you may have clients or family that you know about. Mutual structure, easy underwriting, the history of the company, piece of paper. So ultimately, you have to remember, when you're selling a life insurance policy, you're selling a piece of paper and a promise. So that's why I think that history, the mutual structure, is really, really important. The history of the company is a really interesting story. Way back when the founder started the company in Montpelier, Vermont. And he started the company, he started selling policies, and he sold this one policy to this guy in 1849 or 1850. And what was happening in 1849, 1850? Gold rush. Gold rush. So that too, but gold rush. And so he sold a policy to this guy. And he sold two policies, two $500 policies. Death benefit, not premium, death benefit. This is way back then, which those were big policies. And those are the two biggest policies the company had sold so far. And so he sells these two policies, and the guy decides he's going to go to the gold rush. So he gets on a ship, goes around the Cape, comes up just outside. Before they come into California, he dies. Now there was a clause back then. California hadn't become a state yet, and there was a clause that if you died in another country, then they didn't have to pay. Well, he was on a ship, hadn't come aboard. He was still in international territory, not in another country. He wasn't in a territory, so they could have probably got out of the claim. But National Life Group said, we'll honor the claim. But he went to the board and said, hey, we have a $1,000 claim, two $500 claims. We have about $800 in the bank. What are we going to do? We can close the doors and declare bankruptcy, and we're done. We'll go be accountants. We'll do something different. Or we can figure out a way to pay this claim. So they went to their bank and they borrowed the money and they paid the claim, and they've been paying claims ever since. So it's kind of a great story. They love to tell that story because it shows how, you know, they'll do whatever they have, and they have been. Now, right now, I think they have like for every dollar they have promised in claims, they have between $3 and $4 in the bank. So right now that wouldn't be an issue. So, but it goes back to the history, and again, selling a piece of paper, a promise, because that's what it is that we do. So, and our IUL right now, Index Universal Life is the #2 selling IUL in the market. And I think that's really, really important. Now, for me to stand up and say, yeah, we're #2, that's kind of weird, but the #1 has several 100,000 agents selling it. We have 30-some-odd-thousand agents selling it. So from that perspective, it's, you know, we have fewer people on the street selling it. So we're very proud of that. We've been in the top 3 for 5 or 6 years of the IUL market. So we're very, very competitive on that front. And then you get us, the Alliance Group, and all of our marketing stuff that we're talking about today. So now, you guys got one of these, you got the puzzles? Yeah. Okay. I want to show you how to use these puzzles. Can you open up? So these puzzles, some people like to have little gimmicks and little things, little sales tracks. As you can tell, I'm shy and timid and don't talk very much, so I usually don't have that problem. But
Thank you.
so, how do you use these? If you keep these on your desk or keep them in your pocket, keep out in front when you're meeting with clients, you'll find that your clients all the time say, what is that? And the obvious thing is, well, it's a cocktail coaster I have on my desk. Depending on the client, you may or may not want to say that. But so what I do is I take it apart. You tell me your name. Loranda. So what I would do is I put this on my desk upside down, and I said, let me show you what it is. Loranda, would you turn over one of those pieces of the puzzle? So what do you and your husband have in place in the event that you live too long? People are living longer and oftentimes worry about outliving their retirement. Is that a concern of yours? And do you have anything in place to protect against that? Okay, so we'll come back and we'll talk about that. Can you turn over the next piece? What do you and your family have in place in the event that you die too soon? Do you have any life insurance?
No.
No, okay. So she said no, that's good. But what if she said yes? When people that say yes, what do they usually say? I have life insurance through my
Job.
through my work, through my job, right?
Mhm.
I have. That's fantastic that you work somewhere that offers life insurance through your work, that you have benefits through that. That's fantastic that your employer thinks enough of you and provides those benefits. But what I've found is most of my clients have 1 or 2 times their annual salary, or maybe even $100,000. Is that the case? It's always $50,000 or $100,000, right? Yeah, I have $100,000. See, that's great that you have $100,000, but let me ask you, if you won the lottery, $100,000 in the lottery, would you quit your job? Because that's what you're asking your family to live on forever. Probably not enough, is it? So there you open it up. It's the best way to get by that question of, write that down. Having life insurance through work. You just make a note, lottery. If you won $100,000 in the lottery, would you quit your job? because that's what you're asking your family to live on for the rest of their lives. Probably not enough. But people in their mind think, I have 100,000 of life insurance, I'm covered. That's not enough. Unless you have a lot of other wealth, that's not enough. So turn over the last one. What happens in the event that you become ill? And what do most people say? I have health insurance. Has anyone noticed health insurance is more expensive? Covers less, more co-pays. People might not even have it at all. So more importantly, Mr. and Mrs. Client, if you get sick and are in the hospital, does your health insurance pay your mortgage, your car payment, put food in the refrigerator? It doesn't. And if you're not working, those things still need to get paid, don't they? So health insurance in and of itself when you're sick isn't enough. So what I want to talk to you today about is one product that'll help address all of these financial concerns. So that's how this puzzle works. Pretty cool, right?
Yep.
So
obviously they have term insurance for like 50,000.
down to 100,000. You go IUL down to, oh, they have it?
Then they have to say they have like private medical too. Like,
Yeah, you have the old kind and new kind.
okay.
Yeah, so let me talk, the private, it doesn't
But
go on.
you never try to replace that insurance.
I would, if they have 250,000 of death benefit only. Now let's say they're 10 years into it. I would leave that in place, put another one on top of it. And maybe get another 100, another 250, because that one's gonna run out and this one will go past it. Correct. Now, if they bought the 250,000 a year ago, or 2 years ago, I'd replace it. Just because it has death benefit only. Now, they're gonna be 2 years older, you have to have that conversation, and they may allow you to lower the death benefit in their system. So maybe you lower the current one down to 100 and put 250 on a new one. But don't automatically, my point is don't automatically say, oh, they already have insurance, walk away. The fact that they have insurance tells you that they're willing buyers.
Yeah.
And that they know that they need it. But when you talk about, oh, when you bought this other, and even if you sold it to them, if I sold them the policy 10 years ago, even 5 years ago, and I didn't have this access to say, hey, I need you to come back in because I noticed that that you have the old kind of insurance, and let me talk about the new kind. And maybe we leave that one there and we do another one on top of it. So it just depends on the situation. If the premium is a big concern, then you have to see if it works. So they're going to be older, and it's going to be a little more expensive because they're older than they were when they bought the term originally. So good question. Now, I don't have this on a slide, but I want to talk about another thing too. Is people always want new clients, right? That's how we make a living is by getting new clients and having more people to talk to. Everyone's always trying to get leads and all this stuff. I'll give you a great idea for a lead. I sell one policy. I sell a policy. What's your name?
Joe.
Joe. I sell a policy to Joe, and a policy with living benefit items. And I show up at Joe's house to deliver the policy, and I say, Joe, fantastic, you bought this policy. It has critical, chronic, terminal illness. It does all these things in case something happens to you. And what I've found happens is some of my clients forget about that part of it. They remember they have the insurance, but they forgot about the critical, chronic, terminal illness. And a lot of times my clients don't exercise. They have a year to make a claim when something happens. They forget about it, or they even cancel their policy because they get sick and don't have the money to pay it. So what I want to make sure is that when you and your family needs the money, we can get you the benefits when you need it the most. So what I need from you, Joe, is a list of 3 emergency contacts that if something happens to you, they know to call me to get in touch with you to get you the money and your family the money when they need it most. So did I ask for a referral? No. I asked to help you rather than me asking you to help the other way around, right? Changes the dynamic. It's not a referral. So Joe writes down 3 names, 3 phone numbers, 3 addresses. And I caution people too, because a lot of times you'll have someone working age and they'll put down their 80-year-old mother, which is, that's fantastic. We can put her down, but let's get some folks that we know are going to be around for 15, 20 years that we know that are going to be able to do. We'll keep mom on there too, because maybe mom's going to be that CD lady that we have another sale on, so we don't want to discount that. So Joe gives me 3 names. We have on that website. I'll show you when I go back to the thing. On the website, there's a spot that has this all scripted out. It has the form, it has the script letter and everything. I send a letter. It says, hey, Bob, Joe put you down as his emergency contact. And all of a sudden, we bring him into it. If anything happens to him, if he has a heart attack, cancer, stroke, burn, can't perform 2 of the 6 activities, he has access, he and his family have access to all this money. We want to make sure they get the money when they need it. If any of these things happen to him, call me. Here's my contact information. I wait another week. I call him. Say, Bob, did you get the letter? This is Steve Walter. Did you get the letter that Joe asked for me to send you? He put you down as an emergency contact. If anything happens to him, call me. You see, yeah, I got it. I was wondering what that is. What did he buy? Well, he bought this life insurance. Whoa, I already have life insurance. Well, you have the old kind or the new kind. The people that are doing that are getting about 50% appointments. 50. What? There's not another lead system out there that'll generate 50% of your calls, 50% of your deals. So, and you don't have to buy it. All it takes is 1 sale and 3 stamps.
Wow.
Right? And it works. The only way it works though is if you do it.
And where's that script?
It's on the website. I'll come back to it and show it to you a little bit later. It's on the website, and there's a section on there that shows you. So when I go back and show the next video, I'll show you where that is. Okay. All right. So the life insurance business. You know, there are always continuing products coming out. There's all kinds of changes all the time. There's all kinds of state taxes, regulations, interest rates changing. The DOL thing we went through a little bit. There's all these things always coming, changing demographics. You know, one of the things now with insurance that's really important too is we can write insurance on older people where we weren't able to before too. So we can go all the way up to 85 on our permanent policies. And I will say with these videos, first I'm going to talk to the men in the room. Women go like this. We're idiots. We know everything. And I don't, you know this. I don't, women, you don't have to, but we know everything. And when a man tells you when you're in the interview, says, you know, let me think about it, that means no. And when a woman says, let me think about it, she really wants to think about it. And she wants to go back and ask friends, and she wants to network, and she wants to find out what the deal is and ask people. Where men, we don't want to ask anybody. We know everything, and everything's going to be okay. And let me get out of here as soon as I can. So those videos that we have, the testimonials and those little short videos, when you send them to your clients, send them to the husband and the wife. It's really, really, really important. The man might not even click on it. He might or he might not. The women will say, it'll start the ball rolling. I'll show you some testimonials. We have a lot of testimonial videos of people that have actually had things happen to them. And those testimonials will really set the stage for, it'll ring, the women will get it, and they'll make the men buy. Okay? So as men, we want to send it to our colleagues, a man, and kind of bypass the women because we don't want to talk to them. And we have to get beyond that. We have to send it to the wives too, because you women know that. You guys are the real ones that make the financial decisions a lot of times. We like to think we do. We make all the decisions, or you let us think that. But the women are the ones that will make this happen, especially if their household depends on 2 incomes. Sometimes nowadays it's a little bit different. A lot of situations it's the wife that has a better job than us. It happens a lot more than it used to. So, and a lot of times she's the only breadwinner. That even happens a lot of times. David mentioned earlier, he talked about single women. Single women are fantastic opportunities to talk to them about life insurance because they worry, what's going to happen to me? Now, single women with no kids, why would they buy life insurance? You'd think they would. Like, being a single woman, why would I buy life insurance? But what do single women, especially as they start getting older and middle-aged and into their later years, what do they worry about?
Security.
Who's going to take care of me? When I get sick, I don't have kids, I don't have a spouse, I don't have anybody to take care of me. Who's going to take care of me? Talk about the chronic illness. Now all of a sudden, you're saving money on a tax-free basis, you're building a nest egg, you're having money that you can access tax-free, and if you get sick or something happens to you, you have a bunch of money and a way for someone to come help take care of you. And different than long-term care, it's cash in hand. It's not reimbursement to a nursing home, it's cash. So they can pay a niece, or they can pay a friend, they can pay somebody to come take care of them in their house with that money. Okay? So think about who you're marketing to and who would be a fit, and the women is a different way than we have. Single women with kids, you know, everything is dependent upon their income and their ability to go to work. everything. And so all of a sudden, not just the death benefit if they pass away, but if they get sick. I think it's, don't hold, so I'm being recorded, so I have to be really careful on my statistics. I can't just make them up. It's something in the 70-something percentile of people that die. What happens before they die?
They get sick.
They get sick. And you think a lot of those folks, if they maybe died because they had to go back to work too early because they were out of money. You think they died if they could have got better care, or they would have had more money to get different medicine or different doctors or different things that could have extended their life. We actually had a case several years ago where she went to the doctor, she was sick, she had cancer. The doctor said, I'm sorry, you have to get your affairs in order. There's nothing we can do. And she said, there's nothing I can do? And the doctor said, well, there's actually some experimental treatment in Europe. It's very expensive and not covered by your insurance. She took the terminal illness rider, took the death benefit, went to Europe, and that was like 13, 14 years ago, and she's still alive. Her life insurance actually saved her life. So it's real interesting from that perspective. And a lot of times people say the terminal illness, why would I take a little bit less on my terminal illness when I'm going to die anyway? Let's say today I'm 50 years old, and the doctor said, Steve, get your affairs in order. You have less than 2 years to live. Wouldn't it be great to give that money to my loved ones when I'm alive? Wouldn't it be great to go on a last trip together? Let's say I'm too sick to go on a trip, to bring my family in to see me, right? So it really changes that quality of life down the road when you need the money most. So again, these living benefit riders really, really change the dynamic of life insurance, and they open up the opportunities. You know, back in the old days, we bought life insurance because we loved our families, right? Because it was the right thing to do. And we still do. I don't want to get away from that. That's still why it is. But I have 2 kids, lovely wife, and I buy life insurance to protect them. But there's this little guy on my shoulder that's saying, another $500 a month I spend, what the hell's in it for me? Yeah. Right? That's kind of happens. We're like, you know, but now all of a sudden with these living benefit riders, well, what's in it for me are, I get sick, I have all the access to all this stuff. And on my wife, if she gets, it's not just if she dies, if she gets sick, I don't have to worry about having to sell stuff or having to change or do different things, because now I have a bucket of money to pay for all these things that come up. So it changes that mental hurdle that we never say that out loud, but psychologically we'll say,
yeah,
$500, or $100, or $25, whatever the premium you're paying, you're thinking, you think of it as an expense. And again, some of these videos and some of the things that we do really comes down to telling stories and talking to people about these stories. And you know, that would be a good time to click over to a testimonial. So the testimonials are awesome. So real quickly, this is the website. If you go to prospecting, emergency contact, the whole thing's right there. How to do it. At the bottom there, the PDF content, there's a list. But we had one of our guys gave a great example. He said, I met with this lady and I got the 3 contacts, and she said, wait. She said, I want to reserve the right to give you more names. And he said, okay, in your case, I'll let you give me more names. So it's funny how that works. But so right over here, if you go to videos, here are client testimonials. And so there's a whole bunch of different ones. And again, and I would encourage you to go home and watch them, because they're different demographics. You know, if I have a 50-year-old dock worker, I don't want to send him one about breast cancer, you know, and vice versa. You want to make sure you're sending the right one. Like this guy's a small business owner. This lady, I can't remember what happened to her. This one is a really good one. It covers the cash value, the living benefit riders, and death. All these different stories and all these different things. This one's a really good one because it was only $100,000 death benefit, and that doesn't seem like a lot, but they just bought a house. He got cancer. That $100,000 they got, I don't remember how much they accelerated, but it kept him in their house. He had to quit. He was a realtor, couldn't work for a long time. He went through chemo, the whole thing. And then all these are in Spanish. So very good for this. There's a whole bunch of them on here. So let me pick out a real good one right now. I'm going to show this one. I showed the last time, and I cried in front of everybody because she's passed away. But let me show that one because this one's kind of generic. I mean, from the standpoint of it fits everybody.
I'm Jim Johnston,
I'm Ann Johnston.
and this is our living benefit story. It's kind of weird in life where just a chance encounter or a meeting or one small decision has a profound effect on you later on. You know, Ann met Mara at a networking event. We went to the dinner. We learned a little bit about things. We really liked Mara. And when it came time to start making some decisions, she was our first call.
My name is Mara Simino, and I work with my clients around every aspect of their financial lives, one of the key things being life insurance with living benefits.
I know it was something that had always been on the back of my mind because I knew the importance of it only because of what I'd seen as a caregiver.
I was in really good shape. I surfed, I golfed, I was active. There was no reason for me to think that I was going to get cancer. It happened on a Friday, and when I was diagnosed with cancer, we found out it's called squamous cell carcinoma. I noticed it in a lymph node underneath my jaw. So went to the doctors, they ran a camera down my throat. Sure enough, there was a tumor at the back of my throat, base of my tongue. In the very beginning, we didn't know how bad this was going to be. We didn't know if I was going to live. And we found out in short order it was a very treatable cancer, and all of my doctors kept saying, oh, you're going to be fine. But I wasn't really prepared for the journey, the radiation treatments, and how bad I felt and how much help I really needed. I always thought that if I got cancer, I would die. And it never occurred to me that a cancer diagnosis was not going to be fatal.
Jim and I are friends on Facebook, and he posted one day that he was diagnosed with cancer. It was kind of a shock because they had literally just contacted me and let me know they were buying a house.
And I had the idea that I'm going to video this journey. And originally it was just to be for myself. I thought, well, let's post it. After my first couple of postings, they were a little humorous. I did some filters on there and gave myself 2 heads and said, yeah, the radiation's really acting funny. But then things got serious, and you can see my decline in the videos from when I first started the treatment to where I bottomed out probably in mid-July near the end of my treatments. And then you could see me climbing back up.
I left both him and Ann a voicemail. I said, just want you to know if you need to get some money out of the policy that we set up, it did have living benefits.
So we just had a small policy. It was only a $100,000 policy, and we were able to get 30% of that. So $30,000 put in the account and just have it there in case we needed it.
$30,000 might not seem like a lot of money. We've had clients who've been able to accelerate hundreds of thousands of dollars from their policies with living benefits. But when it came down to it, $30,000 made a huge impact in Jim and Ann's life and giving them the flexibility that they needed to make sure that he could focus on getting better and not have to focus on trying to get back to work before he was ready.
It came in very handy. It saved us. It saved the house. It saved us financially. Even though we had some great medical coverage, there are costs that medical coverage doesn't take care of. You got to pay your mortgage. You got to pay your bills. Your wife has to quit her job to take care of you. Where is that money going to come from? This is where it came from. This is what helped us out.
It made it so finances weren't tough. And I had to keep telling him, don't worry about finances because we're covered. Because of the living benefits, we're covered. So stop.
We didn't lose our house. We're okay financially. So, I mean, how can you put that in perspective of how grateful you are that you met somebody that made that much of an impact on your life? It's just, I don't know how to express it other than really happy. Really happy we met her.
So although it might seem like a small amount, it still made a huge impact in their lives. And it doesn't matter how big or small the claim, having access to living benefits is one of the most important things you can put in place for your family, whether it's a small policy or a large policy.
If somebody's out there thinking about this, is it for me? It's for you. It's an investment in your own financial well-being. And if nothing bad like this happens to you, great. I hope nothing does happen to you like that. But if it does, be ready for it.
Pretty cool, right? So can you see how sending that to a husband and a wife would be impactful, right? And that one, like I said, some of them are very, very like heartfelt. That one, yeah, this one, there's one, some of them that I've actually met some of the people in them, and then I still like, I get up here and I can't continue. That one, Jim's fine and great, and I've met Jim before, so I'm a little better with that one. But you just, again, post on your Facebook page, right? Hey, this I want to share with now, and feel free to share with one of our associates. This is this is one of their clients, and what happened, because you can say that they're one of our Alliance Group clients. So one of our associates, this is their story, what happened. You know, if this is something that you want to talk about protecting you and your family, give me a call. And again, if you're doing it on your personal Facebook page, I wouldn't do it every day. You know, maybe put one of these in, you know, after what you had for lunch every, you know, once a month or something. Don't put it in there because you don't want to be that guy that's, you know, telling you that they're a realtor every day. So, yeah, right. All right, so let's click. I'm going to click through some different things. So again, are you asking questions? Because you know, asking those questions about what would happen if. Those are the real importance. What would happen to you if your income stopped? If you weren't able to go to work? If you're a business owner, what would that mean to your employees and their families? Would the business keep going? You know, if you were unable to come into work, and let's say in the business, is there somebody else that can do what you do? Would you be able to replace you and keep the business going and provide income to you and your family if you weren't able to? So then you start getting into, maybe you should think about a key person policy on your employees on doing this as well. So I know a lot of you guys do taxes, work with a lot of business owners. Huge opportunity on business owners, not only for themselves, but for their key employees. Now, one of the biggest problems with qualified plans, retirement plans for small businesses is, if I do it for me, I have to do it for everybody. And I have to do it equally, right? I can't discriminate. I can't say I like Joe, but I don't like Oscar. Oscar, right? I'm going to give you a retirement plan, but not this guy, right? But let's say Oscar's really good at what he does, and if he leaves, I'm worried about how am I going to replace Oscar. I can say, Oscar, for you, I'm going to start this policy for you. I'm going to bonus you the money to put into it, but only for you. Because he's my key guy, he's going to do it. I can structure that several different ways. I can structure it where I bonus it to Oscar, he pays the tax on the premium, I get the write-off, or I can say, hey, I'm going to take out this policy on you. If you stay with me for 15, 20 years, we've signed a contract, I'll provide you a percentage of your salary in retirement income, like a private pension kind of deal, right? I don't have to do it for everybody else. I only have to do it for him if I can discriminate, if it's not qualified. So by doing that, if he goes to another competitor and says, hey, Steve's a great guy and all, but can you match that? The other competitor has to step up and do that as well. He may not. But if he leaves before the end of that term, I still own the policy. I didn't get a tax deduction. I don't get a tax deduction until I start paying him out of the policy. But I own the policy. The cash value is mine, the benefit is mine, all is mine. And if he leaves, and then I hire this guy, what's your name? Art. If I hire Art, go Art, I can use the life insurance policy on him for his benefit because I own it. It's still on his life, but I own it. So I could do another one on him if I want to, but I don't have to. I have this one with all his captions already. And let's say he leaves and I really don't need to hire Art. Art's going to stay no matter what. I can keep it and use that money for my retirement. So there's a lot of ways on the golden handcuffs that you can do that. Now there's also a way for split dollar where I can say, Oscar, you pay part of the term premium on the permanent policy, the cost of the insurance. So your family, if you die, gets the death benefit, but I get access to the cash value and everything. So that way you get taxed a little bit on the amount of the cost of insurance. When you retire and I start giving you an income out of it, you have to pay the income tax on the money coming out of the policy, but I get it's 100% write-off the deduction for me as the owner because I'm taking tax rate on my policy, paying it to him, he pays, I'm income tax on it, I get the deduction. Pretty cool, right? So there's lots of different things you can do. Is like what the what if? What happens if? Now that was in the business situation. Going back to the home situation, working family, what would happen if one of you, did your mortgage need both of your incomes? Most people today do. You have a will, you have a trust. Now a lot of these are on those questions I handed out earlier. Why would let's say I make $50,000 a year. Let's say household income $50,000 a year. Probably you have a lot of clients that are in that situation. Why would you need a will or a trust? A lot of people say like you don't. A trust, here's why a trust. Let's say I make $50,000 a year, but I have a house, I have a car, I have a retirement plan, I have some money saved. I'm not a big net worth, but I have some stuff. I die, right? I don't have a trust. My wife, I hope someday if I die, I hope she remarries and is happy, right? She might even have the guy picked out for all I know. I don't know. I die, she remarries. They move in together into my house, her house. And I have kids and maybe the new husband has kids and they all live together there. And then they get a divorce. Did half of my stuff just go to the new guy? What happens if my wife dies? It's all his. My kids may get nothing, right? If I set up a trust, and you can do it very inexpensively, if I set up a trust, and the trust basically are a set of instructions that I give it, that what's going to happen with my stuff. If I leave it to my wife and kids, and when I die, she leaves it in the trust and remarries, the new guy doesn't get it. It's hers. It's hers and my kids. Now, if they commingle it and they change it, she takes it out. Yeah, it is. But if she leaves it in the trust and doesn't commingle those funds and keeps it there, it's hers and my kids. I think that's important to some people. Sometimes with second marriages, things happen in life that with the best intentions, but bad things happen. And it's another way. Now, a will is, if you don't have a will, who decides where your stuff goes? The courts, probate, right? Even if you don't have a lot of stuff, the court's going to come back and say who gets what. Will is really important. And it's a great door opener to start talking about life insurance and about different things as well. Now, life insurance doesn't go through probate because it is a contract. It doesn't have to go through probate because it's an actual contract. It says who the beneficiary is. So that's a good thing. If it's set up correctly. I encourage you, if you're, don't name minors as beneficiaries. Sometimes that creates problems. Just ask them, do you have life insurance? People forget to even ask. I've been in the life insurance business for a long time, and I can count on one hand how many times people have asked me to buy life insurance. Maybe people that don't know that that's the big business I'm in. Do you actually get asked very often?
Yeah.
Not often enough. Like the amount of people in the U.S. that have insurance outside of their work is at an all-time low. And you hear ads on TV, but is anyone actually talking? And make sure your clients know that the insurance that they buy on TV, on SelectQuote or any of those, the same insurance you sell them. You're not getting a better deal, but you're getting me as an advisor to help you pick the right one for you. The same price. You have long-term care. Now, let's talk about long-term care for a second. I think everyone that can afford it should have long-term care. So I don't want to say that our product supersedes and is better than long-term care. But what are the problems with long-term care? Number one, underwriting. Very hard to qualify for. Much harder than life insurance. They underwrite for more morbidity versus mortality. Something like walking with a cane might kick you out of getting long-term care. Diabetes. We can get diabetes with life insurance a lot of times now. Early onset or early detected, under control, height, weight, all that's good. If they're into the depths of diabetes, it's a little more hard. It's a little more difficult. They may be excluded from some living benefit writers, but we can get them underwritten on life insurance in some capacity usually. With long-term care, almost never. Number two most difficult thing with it, hurdle is price. It is so expensive, and it's going up more and more and more. There used to be all kinds of companies that had long-term care. Now there's only about 3 companies left that even offer it. Genworth pulled out of it. They were one of the biggest. Genworth pulled out of it earlier this year, late last year. So there's hardly anybody even left that offers it. So fewer companies offering it, companies that have it on the books with no new money coming in. What do you think is going to happen to rates? Cost of medical is going up. People are living longer. So even if you have long-term care, it's probably going to get even more expensive. Rates are going up and up and up and up. So again, hard to qualify for, and it's expensive. So with that in mind, having the chronic illness rider on your life insurance makes a great deal of sense. Now, a lot of people, let's say they're buying an IUL, a permanent policy for cash value for retirement, and they're using it as a savings vehicle. A lot of times we'll sell two policies at once. Maybe a $250,000 IUL, putting as much cash in it as we can, and a $500,000 term. So if any of these other things happen, it doesn't disrupt your savings plan. So again, you can underwrite them. If it's pulled up and it's under $1 million, you can use one app on the Easy app and do them at the same time. You can do a term and a permanent at the same time on one application. So, sometimes you need the death benefit, you need living benefit riders between now and the time you retire, and then after that, you really want to have the cash value in the policy for supplemental retirement income or whatever. Or have a little bit longer, because when is it that you're probably going to need the chronic illness? When you're older, right? So again, don't just think you have to have one policy. You can have more than one policy. We talked about the charity, so I'm gonna go into that. Yeah.
You also don't need to have the state certification for long-term care.
Right. So great point. With long-term care, traditional long-term care, you have to be health insurance licensed, and you have to have a state certification qualification to sell it, and an ongoing training, and every few years you have to do more training for that. Like for the chronic illness rider, that's part of the reason too why it's a chronic illness rider, not a long-term care rider. Policies that have long-term care riders, you have to have that designation to do it. Same triggering things, but because it's part of life insurance and it's an acceleration of the death benefit, you don't have to have that. You don't have to have that extra testing or reg. So that's very good. Good point. Grandkids, we sell a lot of policy on kids, and if a lot of times grandparents want to pay for it, which is great. The only qualification is the parents have to have at least as much insurance as we have on the kids. Okay. Now, if you have a family the family income is $50,000 and you're buying $1 million policy on the kids, it's probably not going to fly. But if the parents have $500,000, you can get up to $500,000 on the kids. So as long as the parents, so even if the grandparents are paying for it, one of our testimonials, a really interesting case, the mom wanted to overfund a policy to save money for her daughter's college savings, but she didn't have any insurance, so she took out a term policy so she could buy the permanent policy on her daughter. The mom got sick, and the only reason she had the insurance was to have it on her kid. She got sick, and there's one of the testimonials, you'll have to watch that one. She got cancer, went through all kinds of treatment, and used the money to do experimental treatment, actually. She's still alive. I've met her too. She's a wonderful lady. But again, the only reason she bought the insurance was so she could get on her daughter, and then ended up she's the one that needed it. And legacy. We'll talk about it a little bit more if we have time. So never assume anything. Now, one of the things we do in our business is we are meeting a typical client in a particular neighborhood that has a job that we already have a preconceived idea of what they want. We go to the meeting thinking, I'm going to sell these guys $250,000 a term. I have everything ready to go, and I know that's what they're going to buy. Don't do that. All right? Because you never know if there's an inheritance. You don't know if there's other money coming from somewhere else. You don't know what their dreams and goals and outcomes and religion with regards to where they want to leave their money and what they want to do. Ask those questions, because those questions will tell you what you need to know. And I love to set the stage with this by telling a little story. You know, I noticed I'm staying at a hotel over by the Bass Pro Shop, so I know there's a lot of guys that fish around here. And there's this one guy that fishes out on a lake up the road here a little bit, and he goes out every day, sits in this lake in his boat and fishes. And he does that not because he likes to fish particularly, but he likes the peace and quiet. He likes to go out there and get away, unplug, and he just sits out there and fishes. And this one particular day, he's sitting in his boat fishing, and he hears this voice from the side of the boat. It says, "Hey, look over here." And he looks over the edge of the boat, and there's a frog. And he picks up the frog. He's holding the frog, and the frog says, "Kiss me, and I'll turn into a beautiful woman. We'll fall in love. We'll get married. We'll have kids. We'll raise our kids. We'll go to PTA meetings. We'll go to baseball games. We'll raise our kids. They'll go to college. They'll get married. We'll live out our days together in our house. It'll be a wonderful, wonderful life." And he looks at the frog, and he starts to put the frog in his pocket. And the frog says, "What are you doing?" And he says, "I think I'd rather have a talking frog." And the reason I say that is because we all have these preconceived ideas of what we want and what we think is best. Sometimes we don't want all that. We don't want that, or the people don't want that, and their situation is different. So make sure that it's not your plan, it's their plan. And the only way you can do that is by asking all those questions. And sometimes it seems a little bit tedious. And you guys, most of the people in the room here come from the tax side. So you're probably a little better at this than the insurance guys that started that way, that are more salesy, because we have a tendency to talk a lot, to talk too much. I encourage you, when you're asking these questions, ask the question and shut up. Let them answer. And they'll tell you. Listen to what they tell you. Don't try to tell your story. Listen to their story. It's a real interesting, I have slides about this, so I'll get ahead a little bit here. There was a study done where they sent this guy into a party, and they had him all mic'd up, and they had a thing in his ear, and he didn't know anybody there. And they sent him into this party, and they tell him where to go, and he'd go and he'd introduce himself, and he'd say, "Well, tell me a little bit about yourself." And the people would start talking, and they would talk, and they would talk, and they would talk, and he would just say, "That's interesting, fascinating." He'd ask maybe a question or two about them, and they'd have a drink, and he'd go to the next person. He went through the whole crowd and talked to all these people. And afterwards, they interviewed the people at the party, and they said, "Oh, that's Steve." And they said, "Tell us something about Steve." They said, "Steve's the nicest guy. He's so interested and engaging and just fascinating." And they went back and they said, "Well, tell me a little bit about Steve." They didn't know what to say other than he was a great guy and he was fascinating. But Steve, they went back and he didn't say anything. He didn't say anything, but he asked them questions and listened. And because he was engaged in listening to their story, they thought he was great. So I love to tell agents that, and people that are talking to people about their insurance, about their stuff, is don't be so quick. Now, it's important to connect with them and find something that you have in common, but then shut up and let them tell you about them. Because they'll tell you everything you need to know. They'll tell you about their grandkids and what sports they're playing and how many of them there are and how much they love them. And this one's struggling in school. They'll tell you this. They'll tell you their wife's is involved in some charity, or she's a long distance runner. They'll tell you all this stuff. And when you're doing the policy, you'll know where the hot spots are. You'll know how to navigate through that. So that's really big. So again, ask questions, shut up and listen. What are your goals, objections, and concerns? One of the biggest things I like to say is, tell me about your family. Never say, "Are you married? How many kids do you have?" Those are one-word answers. See, tell me about your family. And you'll quickly learn, a lot of this stuff right here, worthy of love and meaningful connections and all that kind of stuff. But if you just say, "You married, kids, what's your mortgage?" Ask those kind of questions, you don't get the right answers. Okay, how many we got? 15? Okay, thank you. Are you happy with the amount of money you saved to date? Now that's an open-ended question we know the answer to, because nobody says, "Yeah, I'm fine," right? Going forward, what do you have in place to change the answer to that question the next time I ask you? So start talking about some things. I have some ideas that might provide you a way of saving more questions. Let's change the answer to that question. So again, the IUL story, we kind of talked about how that works a little bit. I'm going to go through some of these slides really quick. The team here has the slideshow too, so if you guys want it, they can get it to you. It's on the computer here. They can forward that to you. But vocabulary, how we use and when we're talking to clients, is really, really important. And what I mean by that is the words we say dictate the emotion and dictate, they convey a message that, it's not lining up correctly. when you're talking about IUL, never, if it's a big case, never say the premium is going to be $25,000. Never say that. Say, Mr. and Mrs. Client, we're going to reallocate $25,000 from this savings vehicle to this savings. When you say reallocate, because the money's still there. When you say premium, the money's gone. When you say reallocate, the money's still there. And it is. It's still there. It's just in a different bucket. So remember, never talk about big premiums from the standpoint of premiums. We talk about rebalancing. Oh, so also, I'm ahead of this slide. That's the next one. Are you compounding or rebounding? Remember I said that IUL has a 0% floor, right? So are you, in your savings account, your 401k, your IRA, are you compounding or are you rebounding? What do you mean? If I have $1,000 in my IRA and I lose 20%, how much do I have? $800, right? The next year I make 20%. How much do I have?
Less than what you started with.
960, right? So on our policy, let's assume a 10% captive so I can do the math in my head. First year we lose 20%. How much do I have? $1,000. The next year we make 20%. I have a 10% cap. I have $1,100. Which is better? Now, if you look at the mutual fund return, -20 plus 20, it'll say, oh, average 0%. No, it didn't. It never even got back to where it was. So it's an important distinction on how IUL works. I got ahead of myself on that one. Again, a client comes into you to talk to you about insurance. Ask them, why are we here? It's hard just to say that and to shut up. But let them tell you. Oh, well, we just bought a house, or, we're worried about something. Let them tell you. And then say, I'm going to recommend this because you told me this. Right? Really, really helps. Money's emotional. On the tax side, it's a different conversation because you're talking about dollars and numbers. On life insurance, you're talking about emotion, and it's hard. It's the F word that we don't want to talk about a lot of times with regards to feelings, because it's a different conversation, and people don't often want to talk about it, but once they do, you got them. You got them as a client, because you're not just the person doing their taxes, the person doing their insurance. You're the person that knows emotionally how you're connected. All right, so I'm going to skip through. We're kind of running out of town real quick here. I went about that real quick. I want to get to, bear with me. Sorry to go through this so quick. I got so excited. I talked about some stuff that wasn't on my presentation. So I wanted to skip. I want to get to, okay, we got this right here. We got that stuff. Okay, this is where I wanted to get, I want to talk about, this is a great case study. I talked about this one a little bit, but there's two case studies here I want to go through really quick. All the time, I meet with people who have parents that are in this situation, or I actually meet with these clients. And because I do a lot of retirement planning and a lot of estate planning, I run up against this a lot. There are so many people. Now, I'm using $100,000 in the case. This was a case I wrote several years ago. That the real number was 500,000, by the way, but just to make it realistic, to make it so that it would be impactful more people. I showed it as 100. But so this is a lady. She's 69. Her husband passed away. She's a widow. She very comfortable. Her current income from Social Security, from everything she has, she gets about $5,100 a month. She only spends $3,000 a month, so she's doing fine. She has $60,000 in an IRA still and mutual funds, and she has about $35,000 cash in her checking account. Her house is paid for, and she has $100,000 in her CD. And then it's there for, she's very conservative. That $100,000 is for rainy day money and to leave to her family when she's gone. She doesn't need it. Income, plenty of income. That's her situation. Are there a lot of people just like this? A lot. Now, what could we do better? She has a CD at her certain bank. It's earmarked for emergencies and to leave to her daughter, who is a single mother and has her only granddaughter. So she said, I don't really want to touch that because that's for them. Okay, that's great, right? So CDs. CDs, you put the money in now, anywhere from 12 months, 18 months, 2 years, 4 years, 5 years. There's different lengths, depending on the length. Sometimes some of the longer ones pay less than the shorter ones. It's some different things happening in the interest rate market right now. But you put the money in, interest rates on CDs have been very, 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 very low. They've kind of come up a little bit. You wait a period of time, then you get your money back plus the interest, which the interest is also taxable. So rather than CDs, I always say, oh, well, you have a CD, you have a certificate of disappointment. Because really they don't pay very much. It's taxable. They're safe, yes. But really interesting statistic is 16 out of the last 30 years, if you have your money in a CD, you actually lost money when you factor in taxes and inflation. The buying power on that money, you lost money 16 out of 30 years. Certificate of disappointment's right? It's really not a great place to keep your money. So you know, when I had to go back and look this up. This was as of a couple weeks ago, some of the better CD rates, the 1 year, 2 year, 18-month rates right now. So it's a year or two ago, these were like below 1. So they've come up a little bit. I think what's happening in the market right now, they might go down a little bit again, but still, it's not a very good rate of return, is it? And it's less than inflation, and you have to pay income tax on that, right? Okay. So is there a better way? Liquidity. It's a viable option with IUL because, yeah, the gains are taxable, but so are they on the CD. And the CD, if it's not qualified, every year you pay the tax, reinvest, pay the tax, reinvest, pay the tax, reinvest. On the insurance, it grows internally. You don't pay the tax until you pull it out. If it's taxable, meaning you just dumped 100,000 in. And which creates a MEC, which I'm not going to get into specifics, but that what's a one-time cash value in a policy would be taxable. But the critical illness is tax-free. The critical injury is tax-free. The chronic illness, the long-term care aspect of it, is tax-free. Terminal illness is tax-free. Death benefits tax-free. Contract passes directly to the heirs without probate. Does that just get better than the CD? And again, the CD, all you have is the cash value. With the life insurance, with the living benefits, you have that 100,000 plus the death benefits, plus the living benefits off the death benefit, not the cash value. If she got sick with the CD, she only has 100,000. If she gets sick with life insurance with the death benefit, she has the death benefit to take the money out, right? So let's look at the numbers. Grandma's happy. Oops. All right. So $100,000 into the policy. I use 6.25. That's below the long-term average. The illustrated is 6.6 right now. I just to be even more conservative. So we put in, here's the cash. We put in 100,000 cash value. In the third year, we're above our 100,000. And here's the cash value. Here's the death benefit. Now, if I wanted this cash value to grow quicker, I could have made this death benefit 200,000, and this would have grown even quicker. But I was trying to get the most death benefit for her granddaughter and daughter versus the cash value, but I wanted to kind of keep the cash value always above 100,000. So again, which is better? So let's look at side by side. See, this is the cash surrender value in the life insurance policy. This is the surrender value in the annuity at 2.5%. I mean, it's not annuity, the CD. So again, 2.5. I'm being generous. I'm assuming people are paying tax each year on it. So we have to, whatever the tax bracket is on that. So we're assuming closer to a 3% rate of return, which is higher than it is now. So giving them the benefit of the doubt. And again, assuming a less than average rate of return on this. 240, our family always has, and she has available for those living benefit riders. Cash value, now it's a little bit behind this because again, the way we have it structured. But again, it's not that far behind, and eventually it overtakes it. And again, if I would have lowered this death benefit a little bit, this would have been a lot higher. So again, because I was focusing on the death benefit. So inside the policy right here will tell you if she got at age 79, if she had a terminal illness, they paid her $206,000. Better than the 100,000 in the CD? Yep. Critical illness at 79, she could get almost $4,000 a month for long-term care, for chronic illness. And critical illness, if she had a heart attack, they give her almost $200,000. Critical injury, almost $200,000 of the 240. Is that better than the 100,000 in the? Always better. So again, all this is in the illustration. Will tell you what your benefits would be down the road. So let's take this one more. Am I out? Am I 11:30?
No, you're good.
Okay.
Steve, can you go back real quick? I think you had up there the actual S&P versus the
Yes. This is really good. This is the actual S&P. This is what it credited each year with the cap. This is within a cap at 11. So really interesting. So it did 19, we got credit 11. It lost 10. This is almost the example I just gave, 20 and 10. And so which is better? You know, we're up over here. But this is really interesting. A 5-year average. Now, we've had a really good run on the market the last 5 years up until last week. Last 5 years average, the actual S&P outperformed us 6.3 to 6.18. All right, so a little better. 10-year average 10 versus 7, but the 20-year average 3.6 is what the S&P has averaged actual with the negative return versus 6.08. It's pretty interesting when you look at it. And I love that page. I show my clients all the time because they say all the time, how can you assume that high rate of return? Well, this is and this is why it works compared to other investments, because you never have. In 2008, what if I needed my income in 2009 and I lost 38%? I didn't lose anything in mine, but your 401k lost a lot. Now, these numbers have gotten a little better the last couple of years. We've got a 19, a 9, a 0, an 11, a 29, 13. So if you take out the last 5 years, these numbers used to be way better. And I suspect in the next couple of years, these will change for the better over here compared to the negative returns we might have on the other stuff. So let's say grandma's exact same situation, but she's taking a little bit of income off that 100,000. She needs a little bit of income to go see the grandkid. But not a lot. She just needs a little bit off of it, but she still wants to leave it to her family. So what I did is I put the money into a SPIA. We took out about $7,400 a year, $100,000 in life option on the SPIA. Okay. So again, for life, she's going to get $7,400 no matter what. We took $3,500 of it. We put it into the life policy, left a $100,000 death benefit, so her family gets $100,000. So she's not going backwards. There's critical illness, all that stuff is still there off the $100,000. She's leaving $100,000, but she's getting $3,500 a year. We assumed a little bit of tax on there. That's why it's $7,000 versus the 74 coming out, because there's going to be a little bit of tax coming off of it. I just blended it out, paid a little bit, left a little bit to pay tax, and so she has $3,500 a year income. Now, is that $3,500 a year after tax more than the CD? Yeah. So this is another way. Grandma now can go do spring break. So exchanging pennies for dollars, that is what we do. We talked about charitable giving a little bit, mortgage protection. People sell mortgage protection all the time because they talk about what happens if you die, but they don't talk about what happens if you get sick, which I think is probably more important to talk about. If you're in your house and your family's still there and you get sick, death benefit doesn't help me at all, right? College savings. We have a great video on college savings. Talk about people, life insurance is a great part of their overall financial plan. When I say that, I mean from when you're doing asset allocation with your financial advisor, one of the things that he talks about is, having an allocation of stocks and bonds, right? And as you get older, the bond portion gets bigger. Well, life insurance is really just another aspect of that bond position. So let's reallocate your bond position from your stock portfolio over here. So that's how to have that conversation. Special needs. Anybody have any clients with kids with special needs? What do you think keeps them up at night? What's going to happen to Johnny when we're not here anymore, when mom and dad are gone? And if you properly structure it, what I mean by that is set up a special needs trust. So let's say I have two kids, one with special needs and one without. I once said normal, but that's the one with special needs and one without. And if I just leave half of my estate to each of them, what happens with regards to Social Security and benefits for the special needs kid? He has to spend all of it before he has access to aid. But if I leave half of my estate to the special needs trust, he can then access government aid and use money out of the trust for when they need it for housing or for doctors or for different things out of that. So what's a great way of funding that special needs trust? Life insurance policy. Take out a second to die policy on mom and dad. Have a 250, 500, whatever amount in there. And the trust can say, here's what we want with this money. We want to make sure
Johnny likes to go have ice cream on Tuesdays, and he likes to go to the park, and here's some money to make sure that someone takes him to do that when he's wherever he is. But he's not going to lose out on Social Security and government assistance because of that. So great opportunity to talk to those parents that have special needs kids. State equalization, how are we doing? Are we out? You should keep going? Okay. This state equalization. Now, we used to sell a lot of policies because of the state taxes. And we still do, but the estate tax right now is quite high. Okay, it's higher, it's very, very high. So we don't sell as much of that. Some states have state estate taxes, Texas does not, so we don't have to worry about that here. So some of you guys in different states, Georgia doesn't have one. Anyone else in any other states?
North Carolina.
North Carolina, I don't think North Carolina has one. I don't know about Ohio. Yeah, I don't think they do. Oregon, Washington, New Jersey, New York, some of those states do. Pennsylvania may or may not. Look it up. It's important to know because usually they're much lower numbers. But estate equalization, what that means is, let's say I'm a business owner and I have 2 kids, one in the business and one isn't in the business. If I just leave the business to the kid that's in it, the other one's kind of out of luck, right? If I split it, is that fair to the one that's been in there working the whole time versus the one that's not? So state equalization is a great way to use life insurance to make, it's a great position with life insurance to make that happen. So here's a case. I actually sent in the delivery requirements on this Friday. This case this is a personal case of mine that was referred to me by an estate planning attorney that I took for one of our CPA symposium trainings. And he referred this case to me right after. Mom and dad, 60, 62, they own a ranch. Really beautiful place. I went there to take the app and deliver the policy and met with them there a couple times. Net worth is about $3 million, mostly in land. They have 9 children. We're up in Idaho, we have a lot of Mormons. They're a Mormon family, 9 children, 29 grandchildren. And it's really neat. You go up on a house, go to their house up on a hill, it overlooks the ranch below, and it pictures of kids and grandkids all over the house. It's kind of cool. But they have 2 boys that run the ranch, the dad and the 2 boys. The other ones are all off doing something else. And the kids are all grown and out of the house. The 2 boys working on it. And when I say boys, they're in their mid-late 40s, mid-40s. Actually, they're 62, so maybe 40, 38, 40. So they got together and they tried to figure out what we're going to do. And they got with the estate planning attorney, and the estate planning attorney called me and said, go see them. They need some insurance. So here's the problem. How do we make it fair for the other 7 kids besides the 2? With no planning, and mom and dad's passing, the farm may need to be sold to divide up the estate. The boys currently working the farm would be without a job and career, right? If they carve it up, it's not worth anything. If the 2 boys got their 2 shares of the ranch overall, that's not enough to make a living for them. So what are they going to do? The other kids may not get anything if the 2 boys got everything. So how do we make it fair? So what we did is we set up a trust, create an agreement between the 2 boys and the parents. The 2 boys will each pay $13,000 a year, $26,000 total towards a life insurance policy on the parents. We use a survivorship policy for $2 million. Mom and dad's passing, the boys will be able to buy the ranch out from the trust at the agreement, and then the other 7 kids will get the money split out. So we did state equalization. Now, depending on the size of the business or the farm or the whatever, just use that as a unit, and it can be, you could go up and down either way. Now, it was interesting when I first, over Easter vacation, they called me and said, hey, see, we're thinking about doing term. And I said, okay, we can do term, but how old are your parents? And I knew the answer. I wanted them to say they're 60, 62. And I said, so for them, we can buy a 20-year term. When do you think they're going to die? 80, 85? Is that really the best solution to buy term for them that's going to kick out? It's going to turn off when they kick out? Probably not, right? So they said, yeah, maybe we should do permanent. And that's how we got it. Because they'd heard Dave Ramsey had heard someone about term insurance is what they ought to buy, and it just didn't make any sense for that situation. All right, I'm going to wrap it up because I know I'm way beyond. Let me see if there's any. I'm still good? Yeah. Okay, I'm going to do talk about this one. We talked about business owners a little bit, attracting and training. This is our example with Art and Oscar here earlier. But look at this business here. This is a window washing company, and I'm still working on this one. It hasn't quite come to fruition. Frank owns a window washing business. Downtown location, he has 10 employees. Joe's worked for Frank for 10 years. Joe, he's his right-hand guy. He does everything. Everybody likes him. He knows everyone in town. Frank's a little worried that Joe knows everybody and so well liked. And he's kind of the face of the company that why he's worried that Joe might go out and start his own company, right? And he doesn't think he will, but he's worried about it. Frank's 50, Joe's 30, both healthy. Frank's kids don't want to get into the business, and Joe's 30, healthy, go-getter, and everything's good. So what do? If we do an IRA, SEP, simple 401k, we can do that, but we have to do it for all the other employees. It doesn't really hold Joe to Frank. It doesn't really do anything to benefit. Buy-sell agreement, yeah, that might be good, but how do we fund it? A buy-sell agreement, say, hey, Joe, someday you want to buy the business from me, Frank. Let's put the agreement in place, how we do that. A 162 bonus. Well, the problem with bonuses is once you start a bonus with an employee, what happens? It becomes expected. Year one, I gave you $5,000. Year two, we don't have such a good year. You're not getting anything. Not good. Employees start looking for another job. So bonuses are good, but sometimes they backfire. Supplemental retirement plan, a SERP, that could be good. SERP, there's lots of different ways of non-qualified deferred comp. You can do a voluntary deferral plan. And again, in today's presentation, I'm not going to get into nuts and bolts of the tax. The 401k mirror plan where non-qualified, I put in some, the employee puts in some, we share the bonus and how that works. Or a supplemental executive retirement plan. So lots of different ways of doing that. So we met with this client, and the SERP would allow additional employer contributions to provide your key employees with extra incentive to stay. So you can put up a vesting schedule and require the executive to stay for a set number of years. So I give Oscar, Oscar, I want you to stay. I'm going to put $10,000 a year into this contract for you. We have an agreement, and you have to have this agreement in writing that says it's yours, you pay tax on it, but you can't touch it or access it unless I give you permission or to a certain amount of time. It's usually 10 years or longer. So it's yours, you pay tax on it, but you signed a restrictive endorsement thing that says you can't touch it. So if you leave, I'm going to stop funding it, it's going to fall. You can't touch it. If you stay, I'm going to keep putting it in until you get that. I get the tax write-off, it's taxable to you. I can double bonus you, so let's say the premium's $8,000, I give you $10,000, you pay the tax with 2 of it, pay the premium with 8 with the other part. So I can double bonus, I can single bonus. I like the single bonus. I think that way the employee has some skin in the game and they get the benefit. So again, a great way from an employer-employee relationship. It's kind of one of the ultimate golden handcuffs. So there's an agreement that says, so here's another way you can do it. Joe stays till 60, then Frank's window will provide $50,000 of his last year's retirement salary. So this would be, I own it, I'm not giving it to you. That's my other way that I'm gonna own it. But if you stay till age 60, Oscar, I'm gonna give you half a year. Now, in the old days, companies used to have to save money for pension plans, right? And they don't do that anymore because it's too much liability. So here's a way to create a pension plan for my key guy, but not for everybody. I'm using the leverage of the insurance company to do it. So now I'm responsible for 50% of his income at age 60. So I got to make sure I fund the life policy enough to create that much income. And then what happens if I sell the company? Well, the company owns the policy, goes to the new company, and because the agreement is with the company. Now, he runs the risk that if I go out, like a bankrupt or out of business, he's out of luck. But don't we have that same risk with any company we work for? But knowing that that pension is coming, in the old days, people stayed with companies forever because of that pension. Now they jump ship all over the place because they take their 401k with them and they move around and there is no pension. So this is a great way to keep Oscar, keep Joe from going because there is that future, contract that keeps them there. So again, I'm going to skip through some of this, kind of get to one thing. There's one last one here, Kaizen. I'm not going to get into how that works, but we could, as an employer, I could actually finance that and only pay part of it and use the bank's money to do the rest. So there's a way we have to actually finance for a key employee. That there was the caveat is the key employee has to make at least $100,000 a year. This one, it didn't work because Joe didn't make $100,000 a year. But you could use, we have a way to help finance that funding of the pension plan for the employer. Pretty cool, right? Credit protection. This is where we write something down. Life insurance is the only financial vehicle that is self-completing in the event that you become critically, chronically, terminally ill before you retire. Life insurance is the only retirement vehicle that is self-completing in the event that you become critically, chronically, terminally ill. It's funny, my guy that helps me with my slides, I said, I need a slide for a retirement vehicle. He put in a motorhome. but the saying is when you're talking to, especially being tax guys and talking to clients about their retirement savings, your 401k, you get sick, you pull money out of it and you're under 59.5, what happens? Taxes and penalties, right? If I need 50,000, I might have to take 75, 80,000, 10% and that. And am I ever going to get back to where I was? Now, some 401k plans have loan provisions, right? When you pay those loans back, you pay it with after-tax money. You don't get to re-put that in there. You pay it back with after-tax money. And because I'm not saving and not growing like I would have been when my money's out, am I ever really going to get back to where I would have been? Am I going to have to work longer? Probably a few more years, right? Life insurance is the only retirement plan that is self-completing if you become sick, critically, chronically ill, or die before you retire. That's really key. So I tell my clients all the time, and again, I do 401ks, I do IRAs, I do SEPs, I do simples, I do qualified planning on that side. I tell my clients all the time is, so you have a 2% match at work, a 3% match at work, do that, that's free money. Never tell them don't do that. But if they're putting in 5% and there's a 3% match, I say, let's take that other 2% and reallocate it over here. You're still saving it. Still, it's after tax, we don't get the deduction, but it's tax deferred, and like a Roth, it's gonna be tax-free coming out. But if anything happens to you before you retire, you just insured your retirement plan. That's it. You just put a wrapper around your 401k, your IRA, that you don't have to dip into if you become critically, chronically, terminally ill before you retire. Right?
And if you send to clients who wanted the deduction down, stop retiring.
Well, if it's a total tax deduction, then again, ask that question. What's more important is being 100% sure you're going to be able to retire with some money, or getting a tax deduction now, and if something happens to you between now and then, retiring at a much lower rate. Let them tell you, because that's the gambit. You're getting a tax deduction on 2%. But again, if you
not if they maximize their 401k, right?
Yeah, okay, so 18 grand. So if you're maxing out your 18 grand, okay, let's take 3,000 of that, reallocate it over here. If they can put away more than 18 grand, then all that's off. By all means, this is fantastic. And IULs work fantastic for people that are maxed out or maxing out the amount of qualified money they can do. So I get clients all the time say, hey, I maxed out my 401k, what can I do? How can I save more money? Well, let me show you another way. But I'm talking about the people that are just doing 5%.
But you don't tell them to lower it to 2 to 3%, take that other deduction.
No. If they have a match, if they're doing 2 or 3%, I leave that with them. I never say do under the match, because I lose my license. Yeah, because that's free money. That's 100% rate of return. So that's the last thing you want to touch. So great question. Great question. But again, we all have clients that are maxing out their 401k. Here's another one that's really big is I don't have a qualified plan, but I don't have one available through my work. I'm maxing out my IRA, or I make too much money for my IRA. That happens a lot. If I'm an employee, I don't own a business. I'm making 150, 200,000 a year. and I'm single, or making more than that with with my spouse, and I'm out of I can't do a Roth or I can't do an IRA because I make too much money. What do I do? No deduction now, but tax deferred, tax free access later on. Plus, you're making sure if something happens, you get it all. All right. So again, my commitment to you guys is over the upcoming months. Let's skip forward this because ongoing training. We're going to set up I'm going to get with these guys, with David and Raul in the back and Karen, about which one to start with. We might throw ITIN in here as well. But licensing, contracting, product, dive into the products a little bit more, software, how to run them, social media, webinars, that kind of stuff. And then schedule these up for you guys going forward, and we'll record them so they'll have them recorded on their site, or however you guys want to do it. So going forward, watch for the notices from these guys. We'll set these up, and feel free to reach out. I'll be here for after the meeting here if you have any more questions and more details. But I know I talked a lot and went through a lot of different stuff, but I hope you got some notes down. I encourage you to check out that website, because there's I only scratch the surface of all the really cool stuff that's there. David or Raul asked me to show one more video before I leave. One about IUL, how IUL works. Videos, educational.
IUL is short for Indexed Universal Life.
There's one for index annuities, how that works. Is this one right here we're talking about?
Yeah.
Okay.
When it comes to retirement planning, there are three kinds of people. The guy who doesn't think about or plan for retirement, you don't want to be that guy. The gambler type who feels the only way to grow her money is to risk losing it all in the stock market, and the play it safe type who shudders at the thought of losing a single penny of his savings, even if it means sacrificing any opportunity for that money to grow. For years, retirement planning has been vastly limited to choices that fall on one side of the scale or the other. And so, money-savvy people tend to invest in 2, 3, 14, 50 different products in an attempt to balance the scale. But what if there was a way to capture the upside potential of a risky product and the downside protection of a secure product all in one solution? Well, hold on to your potatoes. Let's talk about IUL. Indexed Universal Life can harness the best parts of both sides of the financial seesaw. IUL is a form of permanent life insurance that, whoa, hang on. Life insurance has changed in the last 20 years. You know it is something that just pays out when you die. But these days, life insurance can actually be one of the most powerful wealth accumulating vehicles on the market. One huge benefit of IUL is the ability to harness the power of compound interest to potentially generate large amounts of non-taxable cash value within the policy. This cash value can be accessed later in life to fund a happy, healthy, non-taxable retirement. Your IUL's performance directly reflects the performance of the stock market index while implementing a 0% floor and a market cap, usually around 10%. So your cash value participates in the growth of the market up to the cap and sits safely on the sidelines when the market goes down. You forego some of the upside to alleviate all of the downside. So 0 is your hero. With IUL, you won't spend a single day of your accrual making up for losses. Pretty cool, right? Well, it gets better. When designed properly, IUL can serve as a retirement vehicle based on the financial chassis of life insurance protection. And because of IRS tax code exemptions for life insurance, your cash value can create a tax-advantaged way to generate more income in retirement. That's something your 401k or IRA simply can't offer. So what might an IUL look like for you? Let's talk specifics. Larry here is in decent health, a non-smoker, and contributes $500 a month to his IUL starting at age 35. This contribution is conservatively projected to generate $500,000 of cash value by the time Larry retires at age 65. If he chooses to, Larry can turn on a non-taxable income stream from his IUL, giving him $60,000 of income per year to supplement his retirement. And the longer he waits to access this money, the larger it can grow. That death benefit is even accessible when Larry's still living if he suffers a critical, chronic, or terminal illness. So if Larry gets sick, he's covered. If he dies unexpectedly, his family is covered. And if neither of those things happen, the money Larry's paid into his IUL over the years can fund a happy, healthy, tax-advantaged retirement. Assuming Larry lives to age 90, who will have contributed a total of $186,000 into his IUL, drawn out $1.5 million in non-taxable retirement income, and still leave behind a very sizable tax-free death benefit for his heirs. The person who shared this video with you can show you what an IUL might look like for you, given your specific age, health, contribution level, and retirement plans. Contact them today to get the specific numbers and see if IUL is a fit for you.
So there's, again, going back, social media, there's a great place for you to share that on there. On your web, you can put these on your website if you have one, or on your Facebook page, your personal one. There's a whole bunch of different ones on there that are educational from the perspective of like some really good ones. You guys being money tax guys, there's ones like this one's about mortgage protection. This one's about the difference between simple and compound interest, the rule of 72, taxable versus non-taxable, planning for college, fixed index annuities, and then here's some. These are in Spanish. Good. But lots of good stuff on there from how that works. There is one more section here, and then I will. What's down here? Well, those are the main ones. So I wanted to. So a lot of these right here. These are both English and Spanish. So a lot of different. Oh, this one's for if you're business owners. This is a great one to send out to your clients that are business owners. Talks about how to protect your business. Some of the stuff we talked about, but real simple, thought-provoking questions that gets them to call you. So hopefully we came up with something you guys can use, and know that you have the tools through your group here and with Freedom Insurance and what they're doing. And Raul's dove in head first, and he's really killing it. And he just got back from our trip to Dominican Republic. So if you guys do between now and the end of the year, being newly licensed with the Alliance Group, 60,000 of production, and you get to go to Aruba next spring. So if you'd like to go to Aruba with us, it's a great. David can tell you, or Raul can tell you how great the last one we just did was.
You want me to go up there?
Yeah, go ahead.
So I was telling Steve, and I'm going to be a bit on you guys, but I want to say probably the best experience, aside from beautiful beaches and things like that, is just being able to hang out with people that do this business at a very, very high level. I think the gentleman that came in number 1 in 2018.
Yes, 2017.
2017. What was his name?
What's called?
The Asian gentleman.
Oh, there you go. He picked it out. Oh my gosh! I remember one guy. Tran. That's
Tran. Yes, Tran. I know he's younger than me, and I think he did probably about $480,000 premium in 2018. So that's ballpark figure what he made in 2018 just selling life insurance. That's $500,000,000. It's a crazy business. I mean, you can make a lot of money, but money is secondary to helping people, and we're in this business ultimately to help people. That's our number one priority. Number one priority is help our clients, and then number two priority is obviously to stay in business, pay our bills, and make a good amount of money, make a good living. But what I enjoyed about the trip the most was just being able to hang out with professionals that do this business at such a high level. So I'm going to share some of those stories with you when I present for you in a little bit. But all right, I enjoyed it, man.
Thank you, bro. Thank you, sir. Thank you, everybody, and appreciate your visit.
All right, before you get off, we're gonna. If you do me a favor, Steve, can you tell me? I want to do a Q&A really quick before lunch. We're gonna stop at 12:30, but Steve loves to talk, and I like it. Quick question, Steve. So, what did you do before you got into the financial services business?
Oh, so long story. I did a lot of different things. I was a pack guide on the Pacific Crest Trail on horses.
Okay.
Like all the great financial minds in the world. I have a degree in geography and art. So I had a college job working for when the brewery business first started. I worked with one of the first breweries in the country, and managed the brewery, the retail side, and through some circumstances I didn't like it and quit and sold everything. I want to move to Spain for several years. Met my wife to be. My wife is from Spain, so I get yelled at in Spanish every day, like a lot of you guys in the room. And while I was in Spain, got married, and one of my dad's friends who was in the insurance business went to our wedding in Spain and said, "What are you going to do when you get back?" And I said, "I don't know." He said, "Come see me." And that was about 25 years ago. That's how I first got into it. And then I left for a short while and started my own brewery.
Brewery?
Brewery, yeah.
Okay.
Started back in Northern California, and then I quickly realized that I could stay in the brewery business and get a divorce, or sell the brewery and stay married. So I mean, I don't know if I picked the right one, but I'm still married. So been married for, and still married, and to the same wonderful lady, and went back to the insurance business, and we started our own broker dealer. Worked for that firm for a long time, and then the compliance side of the broker dealer, I said, I don't want to be responsible for everybody else. I want to be responsible for me. So I sold the broker dealer. Then the Alliance Group hired me to do the training, and that's part of it.
Awesome. So he's got a background that is traditional for going into financial church. Didn't you say that? Well, isn't that a lot like a lot of us? All right. Well, those are some of the things. Now, today, you support agents all across the country. What are some of the biggest challenges that you see agents face today? And I don't mean just from a product, I mean from a sales perspective.
Well, sales perspective, the biggest hurdle I get, agents ask me all the time, and CPAs even, is how do I talk to more people? How do I get in front of more people, get more clients? And the answer is really simple. Talk to more people. And I know I don't mean to be smug by that, but the art of reciprocation is really big. We all take clothes to the dry cleaner. You talk to your dry cleaner. We take the car to the mechanic. If you talk to your mechanic, your kids in daycare, you talk to your daycare folks. And people know what you do. I tell a story all the time. Is I grew up on a ranch in Northern California, and every spring we do the cattle roundup, and I have about 100 aunts and uncles and cousins. We all come and camp out for a week at Easter. And it used to be our branding and roping and all the stuff you do with calves. But now my dad sold the cows, and we just can't. Now it's a camp out. We call it our annual redneckathon. We all get together and camp out. But I was about 5 or 6 years ago. I'm sitting around the campfire, and my cousin Jamie said, "Steve, what do you know about Prudential?" I said, "Jamie, it's a good company." I said, "Why do you ask?" She said, "Well, because my husband and I, we just bought 2 $500,000 policies with Prudential." And I said, "Jamie, what the hell? Why didn't you call me?" And she said, "Well, I thought you only did investments." Now, whose fault is that? Yours. My fault. So the biggest, to that point, the biggest thing I can tell you guys is you do taxes. Your clients know all of the other services you offer. When you sit down with them, when you mail them, you contact them with a list of the services you offer. Do they know? And let's say it's something that you don't do on a regular basis, but someone in your group does. Put that on the list. Network. I'd rather the business go to David, that he doesn't try to undo what I did over here, than go to some guy down the street and undo it. So put all the services that you offer, and make sure your clients all know it. Make sure that maybe they have another life insurance policy that you can do. One of the services we offer at Liberty Tax or at Freedom Financial, wherever, one of the services we offer is a free financial audit of your existing plan. Work that into your vocabulary. A free financial audit of your existing plan. Let's make sure that your coverage is enough. Let's make sure you're not paying too much. Let's make sure that maybe we can get more coverage for the same premium. Let's make sure the beneficiary reviews. So even if they have a policy that isn't with you and you want to get in there, say, hey, it's really important. When was the last time you reviewed your beneficiaries?
Wow. I
actually had a claim paid to an ex-wife of a client of mine. Got divorced and didn't tell me. Died. His ex-wife died. His current kid's got nothing. He got divorced and died, and no one told me.
Wow.
And so beneficiary reviews are huge. People today get divorced a lot. You'd be surprised how many ex-wives and ex-husbands get paid. It's contract, nothing you can do. The current wife, she can scream and yell all she wants. Current husband, doesn't matter. Even if they're paying a premium. So.
Or additional children, I would imagine as well.
Yeah. Now, a lot of families today, his kids, her kids, our kids, right?
They say no one lasts over 10 years.
Yeah. So that's another important one is how do we take care of my kids, and how do I make sure my kids are taken care of when I'm not here?
There you go. So this is a struggle, is getting in front of people. And of course, using social media, some of the videos that Steve has referenced, the things that he's showing you right now are all ways to talk and get in front of people. And I can't stress how important it is to carry your business cards around with you, to put it on your tagline under your email, on your signature. God bless you. These are all opportunities. So, Steve, I guess the last questions here. Is food here? Good.
No, it's gonna be a little bit. They must have ordered.
Oh, how do you mess up chicken? All right, that's right. I thought this was Chick-fil-A. So we have a few more questions.
Yeah.
You're gonna get grilled for a while. Yeah, I know, right? So now that we're talking about National Life Group, I mean, that's primarily what we offer with Steve here. Who is National Life Group looking for, and who are they not looking for? So if we look at a client today and we look at our client or a book of business in the tax side, what client fits that mold? I know you have a lot of products, there's a lot of variety, but there's some, obviously, just so you know, we're all independent here. There's going to be products that just National Life Group either doesn't want or are just not competitive. And that's it. And I want to know that so you guys know, and let's just focus on what they really are great at.
So we're really good at living benefit riders. We have the most robust. We've been doing it the longest, and so that's very competitive.
What's the number one living benefit rider that everybody wants? I mean, everybody talks about. If you mention all the living benefits, what's the one everybody says, I really want that?
Well, you're at when they know about them, they want them all. But before they know about them, when you mention it, the cancer, the heart attack, the stroke, they really
cancer.
the cancer. Because one of the things I do in a lot of meetings is I say, okay, so stand up if you know somebody that has had cancer.
Stand up.
Stand up if you know somebody that's had cancer.
Stand up. Let's do that.
Stand up if you know someone that's had a heart attack. Stand up if you know somebody that's been in a nursing home. Now, tell me you don't have anybody to talk to.
I don't know anybody to talk to.
All of those family members of those people know the impact of getting sick, going into a nursing home, and the financial impact that creates in the family, and the household, and the lifestyle. If I get sick, my wife's retirement is affected. She's not going to be able to retire when we thought about it. If she gets sick, it's going to affect mine. And people don't think about that. If I get sick, does that mean I have to keep working until I'm 70, 75? And a lot of people don't think about that. So this is just another layer of protection. When you start talking about that, is the videos help. And the testimonies. Now, we only showed one testimony. There's a whole bunch of different ones. And again, I encourage you to go through and watch the different ones and target. Breast cancer is a really big one. I know there's several women that had breast cancer and how that affected them and how they used the money to get better during that time. Breast cancer, the reason I say that too is, we all have family members that have been affected by it, or most of us have. But where we can really make an impact in our community is there's always all kinds of breast cancer awareness walks and hikes at Mike Davis and March, the pink walk and the pink tags and all the stuff you do. And it's a great way if you have an in with somebody that's involved with one of those associations to get involved and help promote what we do at that event. And again, we have some of the tools and some of a booth. We could send you a booth to set up at the pink walk.
Wow, this is good stuff. So number one living benefits, probably cancer. It's probably the number one thing most people talk about today, because it is cancer. Cancer's the devil, right? I mean, it's the one thing that everybody says we don't want to have any part of that, having that benefit. Any other real good things that people are chasing at NLG that nobody else has?
Yeah, well, I'll tell you what we aren't is we're not going to be, if you're looking for a client that wants the no lapse guarantee. Now, the last 6, 7, 8 years, well, more so 4 or 5 years ago, but no lapse guarantees are really big. So a no lapse guarantee policy is one that's guaranteed for life. It's a permanent policy, so it's like a lifetime term. They usually have low cash value, a little bit of cash flow at the beginning, and then no cash value. But the premium is guaranteed for life. Now, that's good, lifetime guarantee, but what it doesn't have is life happens. So because it's a lifetime term, really, if I miss a premium payment along the way, it either shortens the guarantee period or it lapses. So if something happens along the way, you're out of luck. You had it for
30 years, and that happens. When you have cash value in your policy, it provides options. Sometimes you need some money. I'll give you a great example. I have a rental house that I just invested in another rental deal that I didn't have a lot of extra cash. I just put all this money in there. And I have another rental house that water damage in the front wall. They had to take the whole front of the house off, the front of the roof off. And I wasn't sure if my homeowner's insurance was going to pay for it. And so I needed $40,000 right now. I took it out of my life policy, borrowed it out of my life policy, got the construction started while I waited to see if the insurance would pay for it. They eventually did it. They determined that a storm, the water going in first, would start the water damage. Thank goodness. So they wrote a check, paid me the money for everything that I did. I put the money back in my policy. So, you know, I had a bucket of money that I could use when I needed it. So from that perspective, it's another thing to talk about is that when you're paying that premium, it's not going away. You have the money in there. Now, the no lapse guarantee premium is less. There's no cash value. But you have a lot of options. So options are important. Now, one thing I want to point out on the permanent policies too, for the cash value, we're talking about accessing your money. If there's somebody that wants their money right away, this isn't a get rich quick plan. This is a get rich eventually plan.
Yeah.
So if they're trying to borrow money and pull money out in year 1 or 2 or 3, you know, if you think you might need this money, let's underfund it for a little while and then start putting some more money in it to get it going. Let's get you qualified, get it going, and then remember we're going to put more in later if you think you need that until we get through that hurdle. Because the last thing you want to do is put all the money in and then pull all the money out and it goes apart, it falls apart. So
that was good. These are good selling points about the products that National Life Group and LSW, which you mentioned at the beginning. This is kind of interchangeable talk.
Yeah. The lifetime income rider.
Yes. Oh yeah.
There you go.
I didn't even tell you that. I skipped over that slide. So I think there's another carrier that had it, but we're the first carrier to have this. So why people buy annuities for safety and for income a lot of times, right? People buy annuities for income. And most of the annuity products now have, a lot of them, the deferred annuities have an income rider. What that income rider does is allows you to take, the money grows in the annuity, and then at a certain time, the percentage of the cash value that grew to, you can pull out an income for life, right? That's why people buy deferred annuities all day long. We have a lifetime income benefit rider on our IUL. So you can guarantee an income for life on your life policy. So money's in your cash value growing, it grows and grows and grows. You have to have it in force for at least 10 years. And the longer, obviously, the higher the income, you get to age, let's say you get to age 65, age 70, you have all this cash value in the policy. And from that cash value, it's about a 7% rate of return. It's a little bit more, a little bit less, depending on the age when you start every day, but about a 7% rate of return for life off that cash value. So if you have $1 million of cash value, you're going to pay $70,000 tax-free for the rest of your life. Even if the cash value in the policy goes to 0, they'll keep paying. They'll leave a small little residual death benefit there, so there's no taxable issue at the end. As long as the policy is in force at the end, even if there's 0 cash value, they'll keep paying $70,000. Pretty cool, right?
You're no longer paying into the policy at that point.
No. You don't pay any more premiums. You get 70 in that example. So a couple things to consider is if you were just to illustrate taking out participating loans, probably it'd be more than that 70,000, but not guaranteed. 70,000 for life, guaranteed. No matter what happens, you're going to get that money. For a lot of people, that peace of mind. I want to know how much I get in retirement. I don't want to play all these games with the market and stuff. They love it. And the great thing about it is you don't have to choose that rider until you retire. So it's built into the policy automatically. It's not something you add for a cost. It's there, and down the road when you want to access it, you turn it on. There's a cost on the cash value when you do it. It doesn't affect your income because it just makes the cash value go down a little bit quicker, but it doesn't matter.
But it's there.
The death benefit goes down as you're pulling that money out. So the death benefit goes down. So eventually the death benefit's going down, but it leaves, I think, a residual of $15,000. When it runs out of cash value, like it die. I mean, if you're 120, it's still paid. So if at age 100, the cash value is gone, and you die, it leaves $15,000. You're getting that income, $70,000 a year. So for again, peace of mind. And again, that's a pretty powerful tax rate. So like a $90,000, $100,000 tax equivalent taking it out of the qualified plan.
Very good information,
Good.
Raul.
Good.
You want to add anything else here?
I think as so a lot of people don't know that as a life insurance agent, you have access to all of these financial products. You think that the only thing you can sell is term life insurance and simple stuff, but products like an index universal life that can build all that cash value, index annuities, which is what I'm going to talk about next. You being a true financial professional because you have your series licenses. How do these products compare to the products that a quote unquote true financial advisor that has all his licenses, how do they compare? Are they better or are they worse? Like an honest opinion.
Yeah, no, honest opinion. It is one of the buckets that I use for my clients on the index annuities. So index life, index annuities, equities. Now it depends on the client. It depends on their age, depends on what they're trying to do and what they're trying to accomplish. But every one of those pieces of the puzzle has a place. I love index annuities. I sell a lot of index annuities. And I'll be the first to tell you, our index annuities at National Life Group, there's one little niche where we're good, but Raul is going to tell you about some that are a lot better, I'm sure. Our niche is we're one of the few deferred annuities that allows ongoing contributions. So if you have somebody starting an IRA or starting a 12-by plan or starting something, they can make ongoing annuity contributions, which are a lot of ongoing annuity contribution contracts. So that's good. But your traditional income rider, we're probably not the best income play. And you're going to probably talk about other carriers, right? Yeah. So I personally, in my own book of business and in our shop, we use a lot of different annuity carriers for those. And why I like them a lot is here's our safe money. We're going to put this money in there. It can be tied to the market. It can only go up. But some of them have automatic step up, 6 or 7% a year for the amount that you can take out of the income on the back end, and then a percentage based on age. So if the market performs zero the next 20 years, you know how much income you're going to get. And it's going to be more than what you started with, and a lot more. And I use that all the time. It's, hey, we have this money over here in your 401k, IRA, whatever. We don't know where that's going to be. We can guess and make some projections, but we know what this income is going to be. So we can make a projection on your Social Security. We can make a projection that we know exactly what your IRA or your annuity that you have your IRA money in. Off of that money, we know what that income is going to be. And then we have this other money over here that kind of plays hedge on inflation and all kinds of different things. So we don't know what it's going to be, and we can tap that when needed depending on the market. So it's a great way to lock in a real number. Did I answer your question or did I go off? I'm good.
You're good. Glad Raul's good. So we have, I guess our last question here is, you talked about there's an incentive to sell NLG right now to go to, say, Aruba?
Yeah.
All right.
Let's show the video. I think
Yeah. Here, let's. Let me while he's talking about this. All right, while he's setting this up, just to be clear, life insurance companies, financial services companies really love to motivate you to sell. So much so that every year or quarter, there's always a trip that you can win to go somewhere really cool. Aruba. Raul was just in the Dominican Republic, and these trips are paid for by the insurance carrier, full service. Everything's paid for: room, flight, food, excursions, everything. Airfare, everything's it's all complimented because of the production that you produce in insurance. Their minimum, and all of you, or not all of you, but let's say 90% of this room has not sold this products before or has just got their license or their contract with National Life Group. Your minimum is, what is it? You say
60,000 this year.
60,000. So let me tell you how to calculate that. If you're not sure how that's calculated, it's basically your annual premium. So if somebody pays $100 a month on a policy, it's $1,200 premium, and so on and so forth. So if you sold 60 of those in the next, 6 months, 10 a month, you would be going to Aruba next year. It's not that hard. And $100, by the way, for some of these NLG products is not a lot of money. You'd probably be selling 300, 500.
Yeah.
So you could really do some cool stuff. Oh, I like this video.
Yeah. So we our guys every year, our marketing team that creates all these videos, they're really, they try to outdo themselves with the next funniest video that they can do.
And so this is the one. So it says 90,000 up there. So after you've been appointed for more than 1 year, it takes 90,000. So the first year you get with us at 60,000, then it's 90,000. So that's what that means. But so again, remember this is done in jest and funny. So
Not the 90,000,
what?
but the 90,000.
Other hit conferences such as
It was in
Yeah, I have to check it.
comes one of the greatest trips of all time, featuring an all-new destination for the year 2020. Aruba. Introducing Aruba, the 14th annual Alliance Group Sales Conference. The hottest collection of songs and the greatest collection of agents and guest joints ever assembled. Available for the first time from the #1 IMO of all time, including 14 #1 hits. Now's your chance to experience what Rolling Stone magazine calls the hottest life insurance themed album of our generation. Nay, all generations. Featuring such classics as Whistling Again Aruba, the 14th annual Alliance Group Sales Conference, taking over 5 days and 4 nights of all-inclusive, non-stop bliss. Some people think
Underwriters to blame.
Call now and get a limited edition commemorative poster absolutely free. All the songs about Aruba you already know by heart. Qualify now for just $90,000 of paid annual premium over the year 2019. But wait, if you're a new agent, we'll take $30,000 off. That's right. If you're contracted within the year 2019, you'll get the 14th annual Alliance Group Sales Conference for just 12 easy months of $5,000. Don't wait too long. Call in the next 15 minutes and we'll include a bonus track of John Nelson's unforgettable rendition of Don't Stop Believing. Absolutely free. Satisfaction guaranteed. Don't wait. Sell now. Lunch is not responsible for some urgent or sunscreen, folks. That's very important. We're also not responsible for breaking out renditions of Don't Stop Believing while we film. We reserve all rights to keep such footage used against you in future conference promotional material. Please check responsibly.
So first off, let's give Steve a round of applause. If you didn't hear some of the technicalities there, but one thing said you and a guest. So you know if you're going to take your significant other, this is a great way to earn a vacation that's well-deserved. So this is an opportunity for you guys to sell one of the best products in the industry, or if not the best product in the industry, for a lot of the reasons that Steve mentioned today. And so if you haven't already thought about some clients, I ask you right now to get out that little pad that says Freedom on top, the little, I think it's 8x5, whatever it is, the size, and write down 1 through 5, at least 5 clients right now that you can think of, that maybe 5 people you know that could use a policy. This could be nieces, nephews, brothers, sisters, or it could be a client that you already know. And Steve talked a lot about business owners and people who would like to structure ways to sell the business, key employees. These are all people that you know. I promise you, you know them. It's your commitment is to write them out on a piece of paper and go home and talk to these people. And if you need some more resources or help, Raul, who'll be up after lunch, can help you with those things. Steve can help you. I can help you. Our team is here to support you. Now, these may seem complex to some of us. I know that because when I first got into the insurance business, I had a guy like Steve come up and tell me all these things about buy-sell agreements and, investment strategies and indexes. And I thought, what the hell is all this stuff, man? I mean, when's the food coming? Now today I know a little bit more, which makes it easier, but more so it's because I just practiced. I learned. I talked to Raul and I talked to the team and I talked with Steve and I learned. And you all have the same resources. The difference between those who are going to do this and those who don't It's how bad they want it. If you really want something, you'll find a way, and if you don't, you'll find an excuse. So I want to see everybody here going to Aruba next year. Can we agree to that? By the way, how many people can go, Steve? Did you walk out?
Yeah.
How many people can go? I think it's all, anybody, as many who qualify. Anybody who qualifies. So literally this whole room could be in Aruba next year.
Everyone that does 60,000 of production.
So there could be 1,000 people if you really made that many people.